Natalie, just get ready to start. Do we have everyone on the call that we need?
Yes, sir, we do.
Okay. Just give everybody a few more minutes and make sure we don't have anybody joining us, and then get started. All right, well, good morning, everyone. My name is Greg Slater. I'm the chairman of the MDTA board, and we will be conducting this morning's board meeting. I hereby will call the meeting of the MDTA board to order at 9:01 a.m. Due to the COVID-19 pandemic and in accordance with live streaming law, this meeting will be conducted via video conference and being live streamed on the MDTA board webpage. All members will have their video active during the entirety of the meeting. In order to help with the recording of the minutes, all members are asked to state their names when motioning and seconding an approval item. To minimize background noise, I would ask that everyone on the line please mute your phones except when speaking. I ask that anyone who is presenting or answering a question, please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio back on mute. While we have no members of the public who have pre-registered to comment for today's meeting, due to the length of this morning's meeting, I will be taking a 5-minute break after agenda item 11 is presented. But please note that we will continue to live stream during this time and would appreciate if everyone would stay muted. I think we're all getting used to these video meetings now, and you know, we don't have as many issues as we used to. But at this time, I will move on to agenda item 1 and ask for a motion to approve the minutes from last meeting.
So moved. Member Cox. Second.
Thank you. Any discussion on the minutes? All those in favor?
Aye.
Aye.
Aye. Aye.
Any opposed? Great. Minutes are approved, and we'll move on to item number 2. I'll now turn it over to Donna DeCerbo to present our contracts.
Good morning, members. For the record, my name is Jeff Davis. I'm the Deputy Director of Procurement. Donna was not available today. I did update Natalie, but we may not have been able to update the agenda. So the first item I'd like to present is FT 3013, the deck rehabilitation and joint modification of bridges on I-95 south of Fort McHenry Tunnel. The work to be performed under this contract includes joint replacement, LMC overlay work on 8 bridges on I-95, both north and south of the Fort McHenry Tunnel. We received 4 bids. The parent awardee is Marksman Co. at $6,872,549.56. We received no protests, and their MBE plan slightly exceeds the goal by 0.01%. Do you have any questions?
I move we approve this contract. Mario.
Second. Bill.
Thank you. I'd like to move on to the second one. Contract number KB 3015 for maintenance and repair of Curtis Creek drawbridges. The scope of this work includes providing labor, equipment, materials, access and et cetera, necessary to perform mechanical, electrical, structural, general housekeeping, and other maintenance-related work on both Curtis Creek bridges.
Jeff. Can I get pause for 1 second, please?
Sure.
We need to take a vote on that first contract to make sure it's approved.
Oh, I jumped right ahead. I apologize.
So any discussion on the deck rehabilitation joint modification contract for Fort McHenry Tunnel? All those in favor?
Aye.
Aye. Any opposed? Contract's approved. Now let's move on to the maintenance of the Curtis Creek drawbridge. Sorry, Jeff.
I apologize. I was excited to get through all these projects. Okay, so the last statement I was making was that Chimbro Corporation was the apparent low bidder at $2,800,580. There were no bid protests on this project, and their MBE goal exceeds by 0.07%.
Sue, move for approval. Bill.
Second that, Mr. Carroll.
I apologize. You guys broke up. Did you approve?
I'm sorry, I was on mute. Any discussion on the maintenance contract? All those in favor?
Aye.
Aye. Aye. Great, contract approved. Let's move on to the on-call structural repair.
Sure, thank you. This one is contract MR 3022 for on-call structural repairs and miscellaneous modifications. The scope of work includes providing labor, equipment, materials necessary to perform miscellaneous structural, concrete, and other types of repairs, upgrades, replacements, and new construction as directed by the engineer. The work may be required on any portion of any of the MDTA's facilities. This is an on-call contract with parent awardee is Bronner Builders at $10,898,498.20. They submitted a MBE goal that meets, and this project did receive a bid protest.
Jeff, what was the nature of the protest?
I don't want to speak out of turn, but it was related to qualifications. I just had to look real quick. Qualifications that were asked to be submitted for evaluation of experience, and the low bidder did not submit them at time of bid. The procurement officer reviewed it and determined it to be a minor irregularity and allowed them to waive it. So we denied the protest.
Okay.
We are asking for contingent approval because we did deny the protest, but we are still within their period for appeal till 21st.
So we would take this to the Board of Public Works after the appeal time period is over?
Well, we would submit it to Executive Director's office. This would be under our delegation.
Won't go to the board. Okay.
Yeah, and I want to apologize. I misspoke on the first two. We're contingent as well. We have our approved MBE plans. We just need to get the contract back, and then we can submit them to the Executive Director as well.
Okay. Okay. Any questions on the on-call?
I'd like to make a motion that we approve the contingent approval for this contract.
I'll second it. Member Gaines.
Okay. Any discussion? All those in favor?
Aye.
Aye.
Any opposed? Great. Motion carries. We'll move on to the janitorial services for Point Breeze.
Great, thank you. The next project is contract number MT 3134 for janitorial services for MDTA Point Breeze facilities. Contract provides comprehensive janitorial services, including supervision, supplies, labor, and equipment at various Maryland Transportation Authority Point Breeze facilities. The contract will be performed by a community service provider. The Pricing and Selection Committee approved the rates of these services on September 19th, 2020. Janitorial supplies are included in the contract total, and the contract specifies that supplies to be purchased from Blind Industries in Maryland, also a community service provider. Contract will be awarded to the National Center on Institutions and Alternatives, NCIA. for the amount of $1,316,643.16. Since this was a preferred provider contract, there was no established MBE goal and there was no protest receipt.
Great, thanks, Jeff. Just kind of one comment from me, and I'll see if there are any other comments from the members of the board. But these contracts, these janitorial contracts in this pandemic have been critical, and they're critical for the health and safety of our employees that are in there. And so, in many ways, these men and women that are working for these companies are part of our frontline staff. So, just want to stress the importance of these contracts as we go in and we're doing more and more enhanced cleaning on a regular basis and those types of things, and supplementing when we can. But any questions from members of the board on this contract? All right, all those in favor? Or, no, I'm sorry, do I have a motion to approve that contract?
So moved. Member Carroll.
Member Gammy will second.
All those in favor? Aye.
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 Any opposed? Great, motion carries. Thanks, Jeff. Thanks for filling in.
Try my best. Thank you so much.
With this, I will move on to item number 3, which is Kim Melander to present a draft amendment to the board's operating policy.
Good morning, Chairman and members. Kim Melander, Principal Counsel. So in follow-up to our meeting in November, we had looked at some operating policy amendments then, and the board also discussed making a couple additional amendments. So what we have for you today is a specific amendment, and we'll focus on it's a single amendment that would allow one of our committee chairs to request an additional meeting either of their committee or the full board with the concurrence of the chairman. So as you know, at the end of each year, the executive staff puts out a typical agenda for the upcoming year for all your board and committee meetings, and this would allow the calling of an additional meeting either of a committee or board at the request of the chair with the concurrence of the chairman. And I'm happy to take any questions or discuss any other additions or deletions you'd like to make.
I have a question.
Sure.
I'm not sure what this memorandum actually does. I'm not a lawyer, but we can request a board meeting, a chairman or of a subcommittee, or you can request a meeting, but the secretary has to approve. So I mean, couldn't we always do that?
So yes, you're right. I think it clarifies that ability. I mean, certainly, yes, I think any member could probably ask the chairman to call a meeting, and the chairman certainly has that ability to do now. So I think it just clarifies it in the policy and adds that to make it specific.
Encourages it a little bit, I guess. So, yeah.
Well, yeah, I mean, I think there, as committee chairs, you certainly, I want you all to have that most flexibility that you can and being able to kind of call a meeting and do those things and have any discussion that you see any value in. So, so Kim, this just clarifies.
Correct. It just adds a clarification to the existing operating policy to, to make it clear for everyone.
Fair enough.
Great. Any other questions from members of the board? Great, that was easy. Do I have a motion to approve the draft amendments to the board operating policy?
Member
So
Contact, make a motion.
I'll second Von Paris.
Great, thank you. All those in favor?
Aye.
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 Any opposed? Great, motion carries. Thanks, Kim.
Thank you.
We have a couple of update items, starting with Chantel Green to give us an independent auditor's report for fiscal year 20.
Thank you. Good morning, everyone.
Good morning.
Morning. Before I introduce the independent auditor, I'd like to begin by advising the board that for the 7th consecutive year, the authority has received the Certificate of Achievement for Excellence in Financial Reporting for the production of the fiscal year 2019 Comprehensive Annual Financial Report, which is commonly known as the CAFR. The certificate is awarded by the Government Finance Officers Association and serves as the highest form of recognition in the area of governmental accounting and financial reporting. The attainment of this award represents a significant accomplishment for the authority and its management. While the Division of Finance is the author of the report is prepared with the assistance of nearly every division here in the agency. As such, the award is not just an accomplishment for the Division of Finance, but one that the entire agency should be proud of. I'd like to acknowledge all of the finance team members and others throughout the agency who worked tirelessly to ensure that the financial story of the agency was accurate and communicated in a manner that could be easily understood. I'd like to specifically acknowledge several members of the finance team for their work on the 2019 CAFR. That is Luther Dolkar, the Director of General Accounting, Vicki Dobbins, the Manager of Financial Reporting, and Ken Montgomery, the Deputy Director of Finance. As you all may recall, we would typically have what I'm going to refer to as a medallion pinning ceremony. And while that's not possible at the moment, we look forward to pasting the 2019 medallion on the GFOA plaque award plaque at a subsequent in-person board meeting. So with that, I'll pause here to see if there are any comments, and if not, I will transition over to the completion or to the discussion regarding the introduction of the 2020 financial statements auditor.
Thank you, Chantel. It's great to see this recognized. But any questions from members of the board?
Great job to your team, Chantel.
Thank you. Thank you. Okay.
I agree. Great job. Congratulations on the job well done. Thank you.
Well, with that, I'll transition over. I am pleased to report that the authority recently completed its annual financial statements audit for fiscal year 2020. And today, our independent auditor, Clifton Larson Allen, is here to update the board on the results of the financial statements audit. I would like to note that we have a change in our agenda and that we are actually joined here today by Mr. Keith Novak, one of the principals that oversees the authority's audit. And I will now turn it over to Keith to provide the committee with an overview of the audit.
Okay, thank you, Chantel. Again, my name is Keith Novak. I'm a principal with Clifton Larson Allen. I'm neither Clifton Larson nor Allen. I was the quality control review partner, or in other words, the second reviewer on this engagement. Sean Walker, who was the engagement principal, unfortunately couldn't make it this morning due to a scheduling conflict, so he asked me to sit in. What I'd like to do this morning, I believe you all have a copy of a PowerPoint presentation that we had previously provided. But what I'd like to do this morning is just go over quickly an overview of what our audit entailed, discussion of internal control deficiencies, and I can tell you right now that will be a very quick discussion, certain communications that we're required to make, and then just some things about the future and some items that are coming down the pike that may have an impact on the entity. So with that, the key players, there are two parties here. The first is the Transportation Authority, and the key players there in the audit were Deb Sharpless, Ken Montgomery, Chantel Green, Luther Dolkar, Vicki Dobbins, and Cheryl Lewis. And they were very helpful all throughout the audit. It takes a lot to get this type of an engagement done in a timely manner and in an efficient manner, which we were able to do. From the CLA side, the primary players were Sean Walker, who I previously mentioned, myself, Jitana Coleman, who is a director with the firm and was on site, and then Kristen Rohr, who's a senior with our firm and was also on site, or I should say via video, because this was a rather unusual year for getting audits done. And then we also had members from firm FS Taylor and Associates, who is our DBE partner. I will say that this year's audit was unusual in nature, just as all audits this year have been unusual in nature, in that the audits were primarily done on a remote basis. Luckily, our firm has been moving in that direction and was primed and ready to go to a full virtual environment. And I have to say, the Transportation Authority did a very good job in also transitioning to that as well, which kudos to you. There are some organizations that took a lot more to get to that environment, and ones that were much more readily available to be there. As far as the audit is concerned, we once again issued an unmodified or clean opinion on the financial statements. It's the highest level of opinion that you can attain. We had certain areas that we look at that we emphasize. When we're doing the audit, keep in mind that our opinion says that the statements are fairly stated in all material respects. What that means is we don't look at 100% of everything. We do testing and we look at things that we consider to be material. Now, material could be a dollar amount or material could be something qualitative. To give you an example of qualitative, if you had a debt covenant that said you have to make $1 of income and you have only made $1 of income, a $2 error could become material at that point. So we look for material items. Our areas of emphasis are primarily investments, capital assets, long-term debt, revenue and revenue recognition, intergovernmental agency relationships, and then, of course, financial reporting. Now, from a financial reporting standpoint, the fact that you're obtaining the CAFR says a heck of a lot about your financial team and the management there, because that's not an easy thing to obtain. As far as our internal controls are concerned, we evaluate the internal controls for significant account balances and classes of transactions, basically the areas of emphasis. And we look to see if there are any weaknesses that could cause a material misstatement or a significant misstatement of the financial statements. Now, control comments are basically in three types. One is a material weakness, the other is a significant deficiency, and the third is a management letter type comment, which is basically, here's an area you could improve to help out your operations. I'm pleased to report we had no material weaknesses or significant deficiencies to report. And we didn't have any management letter type comments that were reduced to writing. As far as our governance communications are concerned, with regard to significant accounting policies, your accounting policies didn't change this year with one exception, and that had to do with revenue recognition on toll revenues. And that resulted in a restatement of your beginning net position by about $9.6 million. It was an increase in net position, so it was a to the good item. And it basically has to do with the timing of toll revenue. Accounting estimates, there are certain estimates that are made in the financial statements. Not everything is driven by a dollar spent or a dollar earned. There are things such as the allowance on collectability of receivables, pollution remediation liabilities, capital asset depreciation, and pension liabilities. All these are estimates made by management in putting financial statements together. We look at the estimates, we look at the methodology used, we look at it for consistency, as well as is it what is being done industry-wide, or in some cases, statewide. Is this something that's normal in governmental industry? And we had no issues with any of the estimates. With regard to financial statement disclosures, as I said, we had one restatement. Outside of that, the disclosures are pretty consistent with the prior year. We didn't encounter any difficulties in performing the audit. We had no uncorrected misstatements. That would be things that came up during the audit that would have required adjustment, but management determined not to make the adjustment. There were none of those identified. And we had no corrected misstatements, meaning that nothing as a result of our testing created or caused a journal entry or a change to be made to the financial statements. We had no disagreements with management on accounting or other issues. At the end of the audit, we asked management to provide us with a letter of representations. And that letter is about a 6-page letter, but to boil it down, it basically says, we provided you everything, we didn't hold anything back, and we answered all your inquiries honestly. But it takes about 6 pages to say those three things. To our knowledge, there were no consultations with other accountants on accounting or auditing matters. We had no significant issues that we discussed with management prior to our retention. We were hired based off of an RFP and a bid situation. And there are certain other items that are in our financial statements, but the financial statements should be used in their entirety. If you decide to put together some type of other report that includes reference to our financial statements or our opinion, we ask that you provide the entire financial statements or let us review prior to issuance. And that would be in things such as if you had a bond offering, we would want to make sure that the statements were included in their entirety. A couple things for the future. There's going to be a lot of changes in financial reporting in the upcoming years. Now, most of those changes aren't going to affect the authority, but we should make you aware of them. The biggest ones right now are leases, and that change is going to change the way operating leases are recorded. At this point in time, operating leases are recorded as they're paid. Going down the road in the future, operating leases will be handled the same way as capital leases are, and that is you will have a liability on your financial statements and you'll have an offsetting asset. At the end of the day, it won't have a huge change. However, putting those liabilities on your books may cause an issue with any loan documents you may have or any bond documents you may have. So in the event that you have significant changes as a result of operating leases, you really need to have someone take a look at that and determine the effects, if any, on any bond covenants or loan covenants you may have. Fiduciary activities, there's no effect on the association that I can see, or on the authority. Subscription-based information technology, that standard has to do with leasing of software. You know, I'm old enough to remember that when computers first came out and were being used by business, software was leased. You didn't own your software. Then we went to a situation where everybody owned their software and updated their own software. And now we seem to be going in the direction of, again, leasing software as opposed to owning it. So to the extent that you have leased software, then the subscription-based information technology standard will come into play. And then the last one that probably will have an impact or may have an impact is the change in LIBOR rates. As one may know, LIBOR is going away. And there are a lot of loan documents out there that have floating rates tied to LIBOR. And so a standard was put out by GASB just to clarify that a change in the rate from LIBOR to something else would not necessarily create havoc in the financial statements because there are certain standards that key off of those rates. And then the last thing I'll note is my understanding that you're changing your service organization for tolling activities to TransCore, or already have, and that may have an impact on the financial statements and getting the audit done, only because we have to interface with those entities. We're very familiar with TransCore, so we don't see any issues there. So with that said, I know it's a lot of information in a short period of time. If anyone has any questions, I'd be more than happy to try to answer them. If I can't answer them, I may have to get back to you.
Absolutely.
I've got a question.
So much for that update. Questions from the board? I think it was Member Gaines.
Yeah, I had a question. Mr. Novak, I guess this would come under governance communications, but you know, the video tolling underwent a big change in the midst of the pandemic, and we changed the rate, we changed the billing, and I don't think that was a great chapter for MDTA as far as communications. I don't know, it just seemed like it slipped by everybody and the revenue implications therein. And you didn't seem to have much comment on that.
Well, I wasn't involved in the day-to-day and any communications that may have transpired on that, so I wouldn't be able to address that. I was involved on the back end in reviewing everything to make sure that was done in accordance with standards. I could certainly communicate that with Sean and have him get back to you on that.
Okay.
This is Deb. With the decision to recognize video revenue on an accrual basis, and that's the only piece that we changed, is the video piece is recognized on an accrual basis instead of in a cash basis for financial statements only. For our financial forecast, it's still all done on a cash basis. That is standard accounting practices, and it's been something that we've been working towards for many years. We never used to have the reports to be able to do it. And with AET, it's made it material to us. So in the past, we were able to account for it on a cash basis because the difference wasn't material enough to affect our financial statements. But now with permanent AET in our future, we need it to go to an accrual accounting, and we didn't wait for that decision. There was, and it's noted in your materials, there was one entry that we did not record, and it has to do with video transactions. For those notices that we had not mailed, we did not record them as revenue. That's the $7.5 million you see in your materials. And we did not record that because that's consistent with all other toll agencies that we are aware of. They do not recognize revenue until actually billed. And so although from an accounting perspective, we could make the argument that it was earned revenue, we felt like consistency with our peers and not making decisions that are like COVID specific, but rather making decisions that withstand any economic times is why we didn't record those, because we were very, very conscientious about not, making too many actions and making sure that any action we did was a long-term decision and not a short. So, Member Gaines, I hope I addressed your question. If not, I'll be happy to narrow my response.
I guess you spoke on really how we categorize the revenue. So I guess your position is really the decisions made there not to bill and all that, we're not really going to affect revenue in the long term. We're going to collect most of that money, I guess.
Right. That's right. And when in a few minutes, we're going to talk about our traffic and revenue forecast.
Right.
In a lot of detail. And we'll go there. But for this fiscal year, the video that was not billed as of the end of fiscal year, we did not recognize that revenue.
But it'll be in the next fiscal year.
Yes, because that's the year we will have billed it.
Right.
And we felt it important to be consistent with other toll agencies.
All right, thank you.
Any other questions from members of the board? Great, thank you, Deb. Chantel, does that conclude the presentation?
Yes, thank you.
Great, thanks so much. At this point, I'll stay right with Deb, and she can give us an update on the traffic and revenue forecast.
Okay, thank you.
Good morning. For the record, I'm Deb Sharpless. I'm Chief Financial Officer for the Maryland Transportation Authority. The following items on your agenda, some might describe it as finance a rich agenda. And I want to, before I get started, kind of frame a couple of those. When we talk through items 5 through 11, beginning with the traffic and revenue, collectively, this is our financial plan. It's all wrapped up in item 10 with our financial forecast. But, we're going to start with talking about revenue and what do we see happening with revenue with an updated forecast. We'll move on to the 21 budget then the 22 operating budget, capital, a cash refunding, and then everything's wrapped up in the financial plan. And collectively, even though we present these individually, they all work at the end financial plan. And then I'll conclude with revenue sufficiency, which is that we do not need a toll increase during our 6-year reporting period. And this information was first presented verbally to the board at the October meeting. And then each of these items, we spent a fairly long finance committee meeting going through each of them during that time as well. So before jumping into the revenue, I just wanted to frame this part of the agenda because each piece fits together. So if there's not any questions, I'll start with traffic and revenue. And in your materials, you have the summary memo that's consistent. We also provided graphs. We think that in this situation, graphs communicate the picture much better than just the words. And then we've also given you the entire CDM traffic and revenue report. We recognize it's very long, but felt it was important that we continue to provide you the entire report. So I'm going to start with figure 1, which is the ICC and the ETL. And this has to do with like COVID and what did we see and where are we now? The figure 1 is the ICC and the ETLs. And you can see that we had a abrupt decline in traffic beginning in March. We plateaued around April 15th. The ETLs plateaued at 85% below pre-COVID levels, and the ICC plateaued at 70%. Today, the ICC is 35% below pre-COVID levels, and the ETLs are 40% below. This is expected because these are two congestion managed facilities, and if there's a little bit less congestion, a little less people on the road, right now during this short period of time, you would expect these roads to have the same. Now, in a few minutes, we'll look at the forecast into the future, and you'll see recovery. So moving down to the second figure, this is the legacy facilities for passenger vehicles, which is essentially all of our facilities except for the ICC and ETLs. And you see this same steep decline where we plateaued 63% below pre-COVID levels around April 15th. We have had a steady recovery up through July 1st, at which time we've leveled off and we're about 17 to 20% below pre-COVID levels. Now, the following graph is our commercial traffic on legacy facilities. And you can see we still plateaued in around April 15th, but the decline was much less and the recovery has been back to pre-COVID levels and we have been sustaining. And where we've been since July 1 has been, 2-3% inclines, but much more gradual than where we were once we started increasing in April to July. So that's from a COVID perspective. Next, I want to move on to our actual financial forecast. But before talking about the following graphs, I want to refer you to the traffic and revenue actual report. On page 4-2 is a list of assumptions in our forecast. It's page 4.2, it's table 4-1. And these are the assumptions that are incorporated into our updated November 2020 forecast. First is it assumes COVID impacts, impact factors that we had assumed before, plus there's a few adjustments, particularly for this winter and passenger vehicles to assume a little bit of further reductions. We incorporate construction projects and any impact construction has on our project. The 895 bridge replacement is the best example of that. The cashless tolling, this forecast assumes AET on a permanent basis. The prior forecast did not. It assumes video toll rates resume January 1st. Invoice noting resumed October 15th, which it has, and that we would process 1.8 million video transactions per month, where we would be ramping up to that level, achieving it by the end of January. Civil penalties are the reduced $25, which had been approved by the board previously, is incorporated in this forecast. That also was in prior forecasts. Vehicle registration holds, we are assuming that they will not occur in fiscal year 21, but they will resume in 22. CCU tax intercept programs also, we assume they do not occur in fiscal year 21, but resume in 22. We assumed pay by plate and the new vehicle classifications would be in effect at January. At the time of the forecast, that was better information we have. We now know that will be later in the program. That does not have a negative effect on our traffic and revenue. It actually has a positive effect, any delay, because part of these toll modernizations, it was reducing tolls for customers. And then commuter and shopper programs resumed November 1st, which they have. And again, the forecast is on a cash basis, which is consistent with all prior years. So they are the assumptions that is the basis for the remainder of our conversation about what our forecast looks like. So I'm going to refer back to the figures that we gave you. So on figure 4 is our traffic for our legacy facilities. And even in the October meeting, I talked about this steep V and how we have a V and a recovery. Each one of these figures, you'll see that V and you see us coming back in fiscal year 22. And that's what we meant by COVID is having a short-term impact, the most significant in fiscal year 21. And therefore, in the remainder of our materials, you'll see us with short-term strategies so that we align our strategies to the time period that we're impacted and not take huge adjustments or huge strategies that have long-term impacts on the agency. So now the other thing that you'll see on figure 4 is the solid blue line is our November forecast. And we are below where we were June. That shift, when you get out to 23 and beyond, that's because of AET. With AET, you have greater leakage. That's standard, all AET facilities, but there's other costs that you avoid and that helps you recover that. So you won't see that gap when we look at it from a revenue perspective. So on the next figure is revenue for the legacy facilities. And you can see how we have this V again that's coming down. This is COVID, and a piece of this is also mailing the notices later. Looking at the customer, making customer-focused decisions, and delaying the mailing of the notices. So this V is a piece of it is that, but it is primarily COVID. And then you can see us recovering a little bit above where we thought we were going to be in June, and then we come back right where we were in June. So that little bit of recovery above, that's a little bit of the lag with collections on video notices. And then the dotted light blue line, it was a year ago's forecast. So then if I go down to the next figure, this is the ICC and the ETLs. You see that same V. It's not quite as as pronounced, and then but the shift is much more significant from where we were in October of 2019. Same thing, you see us coming back out, and then we're, you know, in close to where we were in June. And if I move on, now we've shifted gears on figure 7, and we're not talking about traffic anymore. We're going to shift, and we're talking about revenue at this time. And so, and for the ICC and the ETLs, traffic and revenue line up very, very closely with each other. And you see the same decline in 21, starting to recover in 21 through 22, and back up to where we were in June 2020. The conversion to AET obviously had no impact on the ICC and ETL, as they were already AET facilities. So then the next, I want to make sure, next figure is figure 8. This is total administrative revenue, commuter plans that aren't used, civil penalties, and you can, same V, it does go higher. We'll have such a larger percentage of customers that are video customers, and some of them will not pay within the 30 days that they're allotted. And then the last figure is where everything is pulled together. This is all of our facilities, and you see that, you know, once we get beyond 21 and 22, we're seeing a little higher revenue than where we had forecasted in June 2020. So that's so let me pause there and see if there's any questions. I didn't go, you know, next to each graph, you see the numbers, you see how they've changed. I just thought visually would facilitate a better conversation.
Yeah, thank you, Deb. Certainly a lot of information. Let me start. I've got a couple of questions, but I'm going to kind of go to the board first and see if there are any questions from members of the board.
Mr. Chairman, I have a question. This is Member Von Paris. And Deb, thank you for the detailed report. And we also went over this at the Finance Committee meeting in great detail. The 1.8 video processing, ramping up to that on the one to get to 1.8. I think are we about 1.3 now?
That is what we're forecasting, like right now. That's our preliminary numbers from where we're just a month into ramping up. That, you know, we believe we're right around 1.3 million. We're working on being able to take actions to be able to get to 1.8 by the end of January. We are constantly running different scenarios and what ifs. And so from a revenue impact, you know, I did ask the question of our T&R consultants, what if we couldn't get to the 1.8 until April? And I just picked April. You know, it's a couple months after. The revenue impact is $2.7 million. So, you know, at each time, each thing that we are off from our original assumptions, we're analyzing what does that mean from a revenue perspective. Right now, we're about 1.3.
Okay. And as far as the tracking of it and I guess establishing goals where we want to be on a timeline, I guess we're going to do that and then monitor it very closely. Yes,
we are. And it's a combination of monitoring the number of notices that go out, our payment rate, trying to analyze customers that proactively go to the website and pay before they ever receive a notice. And all of that collectively results in our cash flow. Easy Pass penetration, how does Easy Pass grow, is also part of the analysis and the effectiveness of our marketing campaigns.
Mhm.
So we will very closely monitor all of those aspects that affect our revenue, which will ultimately affect our cash flow.
Thank you.
Any other questions, members of the board?
Deb, for the projection, I recognize that revenue's down for this fiscal year, and I know that they projected that we had a decrease, and now we're coming back up. They anticipate if we have another, whether it's another shutdown or, I just read that 90% of people are going to stay home for Thanksgiving. So that's obviously going to impact traffic and travel on a probably typically a high revenue day for us. So how is that taken into account, and how can we in real time keep track of this as the situation evolves?
So our forecast, the new forecast, the November forecast, for the months of December, January, and February, passenger vehicle traffic assumed an additional 3% reduction above the previous COVID reductions that we had assumed. And that is to assume a slightly worse winter than what we had originally, what had been forecasted in June. So, in that respect, we have a little bit more adjustments, but it's something that we need to watch. And as we monitor, a later item is we're coming back to you to make adjustments with our operating budget for 21 to make further reductions. And that's part of us aligning our expenses with impacts on revenue. So as we monitor this year and next year, there opportunity, or not an opportunity, but a need may occur that we have to come back to you. When we talk about the forecast and being above our coverage levels, I'll speak to the, call it our cushion. How much can revenues decrease, or how much can operating expenses increase, without us having jeopardize our 2x coverage. And for fiscal year 21, based on everything that you're going to see today, that cushion is $70 million. So, it's larger in 22. Fiscal year 21 is definitely our harder year.
Can I piggyback on that question?
Sure.
Obviously, there's a lot more people working from home these days also, and that's probably going to be a trend that obviously some people want to get back to the office, get away from their kids or their spouses. So I get that, but I also think that some folks are going to stay working from home. So how do we figure that into our forecast as well?
The forecast, even the June forecast, incorporated, because you can see, I'm looking at figure 9 still. The dotted blue line was our June forecast, and you can see how it's shifted down from where we were in November of 19. That's a combination of prolonged economic recovery as well as changes in individuals' work habits or traveling demand. So there are some assumptions built in that as we figure out what the new normal is, there is some of that built in here, and that's why you see this shift from where we were in November of 19. But it's, back in the 2008, when we went through the, Great Recession, and we talked a lot then about needing to figure out what our new normal is. And it's the same thing here. We'll have a new normal. We have the flexibility to make adjustments as we learn what that normal is going to be.
Thanks, Deb. I had a very kind of similar question. I think I'm asking the same question in a different way. One is, I think the majority of our assumptions are pretty conservative, and I think that's a really smart play right now because we just don't kind of have a lot of kind of certainty on kind of where we're headed. But as I'm looking at these charts purely from the traffic perspective, it looks like we based on this forecast, we never get back to where we thought we were going to be in last year's forecast. And so that's kind of that new normal. And, my question was, how do you account for that? And I think it sounds to me like we're accounting for it in some way. What is that new normal? That next year's forecast could have us back to where we were in 2019. We just don't know. But this is just based on our conservative forecast. Is that accurate?
Yes, we try to take a balance with being conservative, right? Because the lower our forecast is, that does affect capital projects. So, we don't want to lower our forecast so conservatively that we're not delivering projects to our customers. But at the same time, we recognize we have to achieve our forecast. And so we try to strike that balance that if we achieve higher than what we're showing here, we can add projects. And that is so much easier than taking away something. And so that's also why you see us below where we were forecasting a year ago, to ensure that we can achieve this forecast.
Thanks, Deb. I know I've been spending a lot of time looking at forecasts for not only our traffic, but also for transit and for air service and container volumes coming into the port. And they're all very different types of recovery graphs. So, it's pretty interesting. But any other questions from members of the board? Great. Thanks so much. Does that conclude your presentation on the forecast, Deb, or do you have a little bit more to go through?
No, that's our forecast looking forward. In your materials is a summary memo as well as the report. It's, as you can see how thick it is. It's that there's additional information there, and we will be updating the members, as we always have, on a quarterly basis.
Great. Thanks so much, Deb. Well, why don't we, thanks for that update, Deb. It's a lot of information. So, I hope members know that if you have any kind of follow-up questions later on, you can certainly work back through staff and get any kind of questions you have. I know I see something new every time I look at it, and I've looked at it a few times now. So, but thank you all. But let's move on to item number 6 with Christina Thompson to talk about our amended operating budget.
Good morning. So I'm here to request approval of the amendment to the FY21 operating budget. This amendment is a reduction of $19 million or 5.9%. The amendment was presented to the Finance Committee and received concurrence to move forward. As a result of declining revenues due to COVID-19 and other customer-focused business decisions, MDTA found it necessary to reduce the operating budget in order to stay in compliance with its policy and legal financial requirements. This budget reflects the reductions necessary to maintain compliance and is a short-term action to align revenues and expenses. The amendment includes the following significant changes. There's a $3.7 million decrease in personnel expenses, including a decrease in pension and unemployment rates, reductions in overtime, removal of the police step, and there's also a slight increase in salaries and benefits to fund some positions that we did not fund. They're exempt from the hiring freeze. There's a $13.4 million reduction in contractual services, including engineers, roadway repairs, IT services, and Easy Pass Service Center costs. There's a $3.4 million reduction in supplies and materials, including transponder, salt, various maintenance materials and uniforms. There's a 0.5 million reduction in replacement and additional equipment, including deferring servers, ETIX units, and other maintenance equipment. There are a few increases included, including like a $1.5 million increase in statewide telecommunications for MDTA shares of the cost for the radio system, and a $0.4 million increase in fixed costs, mainly for insurance. Again, these are short-term cuts needed to maintain a financial compliance. Senior management worked hard with budget staff to develop these reductions, which we feel are achievable. No different than in the past, if we learn these reductions are not sustainable over the short term, we will come back to the board with adjustments. With that, I would be happy to answer any questions.
Thank you, Christina. I know these adjustments are definitely in line, if not less than some of the operating adjustments we've had to make in some of the other modes of transportation. So no questions from me. Any questions from members of the board? Okay, with that, do I have a motion for approval of the amended operating budget?
I make a motion, Member Cox.
Great,
A second, Member Gaines.
great, thank you. Any further discussion? All those in favor?
Aye.
Aye.
All right,
Any opposed? Great, thank you. Thank you, Christina.
Thank you.
With that, we'll move on to the FY22 preliminary operating budget with Jeffrey Brown.
Good morning, members. First of all, I can't quite tell. Is everybody able to see me?
Yes, we can.
Okay, great. My name's Jeffrey Brown. I'm the budget director of the Maryland Transportation Authority, and I'm here to request contingent approval of the preliminary full year 2022 operating budget. This budget reflects updated operations to align with the new realities as we emerge from a COVID-19 pandemic. This isn't exactly like a pre-COVID-19 budget, but it's more in line with one of those. And you'll see that impact as compared to the various budgets. The proposed budget is for $335.2 million. This represents 11.6 million or 3.6% increase above the final 2021 operating budget. We're comparing it to the 2021 amended budget that Christine just brought us through. The budget is the budget increases by 30.6 million or 10.1%. However, when we compare this to the full year 2021 preliminary budget, which is more like a pre-COVID-19 budget, the budget actually shows a decrease of 2.8 million or 0.8%. To better understand these changes in the budget, we broke it into three categories: mandated increases, which are kind of self-explanatory, things that you have to spend on, and then some discretionary additions and reductions. For the mandated increases, increase 6.4 million. They were number one, 1.7 million allocation for the state radio system from DBM. This is something that wasn't in previous budgets. In addition, we have an increase in the employees and retiree health costs, as well as Social Security. Combined, there were 4.7 million, and they were both due to the anticipated termination of the hiring freeze. So that generated the increases for the mandated increases. For the discretionary spending additions, we expect about 20.2 million increase. The major increase is due to filling vacancies due to the anticipated termination around the hiring freeze, and this is worth 9.2 million. In addition, as we transition to cashless tolling, we're expecting some additional credit card fees for Easy Pass and the greater use of the transponders as well. These combined effects are worth 2.9 million. The fleet allowance for the year, which is to replace vehicles past their useful mileage or years, we expect an increase of 2 million. Looking at the memo, the next three relate to IT costs. The first is for net app storage and is an increase of 1.5 million. This is for what's typically used or upgraded every 5 years. It's a maintenance item, and this ensures proper support for your back-end things such as computer files, databases, et cetera, things of that nature. In addition, we expect a 1.3 million increase for replacing computers past their useful life, usually 5 or 6 years old. And again, that's $1.3 million increase. Finally, IT anticipates some additional contractual services and some new tools, such as a budget tool for finance and a health and safety system as well. These combine to increase the budget by 1.1 million. We expect some additional equipment at JFK, some mowing equipment, salt grind maker, expect to increase the budget by 600,000. Some insurance increases are expected, some in premium increases, which will be worth about 500,000. The indirect costs around police support, application software costs, and education and training, all three of those items, we expect to increase by about $300,000 versus the prior budget. And finally, ammunition increases by about $200,000. Some of the highlights around the reductions are as we transition to a new vendor for the Easy Pass Service Center, 2 new vendors, we expect those costs to be reduced by $7.5 million. In addition, normal turnover of personnel, we expect that will result in about $3.4 million in reductions. Engineering costs are anticipated to be $2.5 million lower. This is a strategic focus on our part to reduce those costs, number one. And number two, there was a revised inspection requirement approved by the board that results in savings to this as well. The capitalization of the AET work has reduced our operating costs around building repairs and maintenance by $800,000. The reduced need for in-lane toll collectors reduced additional assistance personnel costs by $300,000. Normal employee reclassifications are expected to reduce by $300,000. And office assistants, again, as we fill these vacancies, there will be less need for expected office assistants. So we expect a reduction of about $100,000. And then finally, just some miscellaneous other types of reductions, about $100,000 as well. So that concludes my presentation for the FY 2022 preliminary budget. I'm happy to take any questions at this time.
Great, thank you so much. No questions for me. I will make one comment that it's great to see the new purchase of one of the salt brine makers. I know I've talked about this with our team at State Highway a lot. I know we had a lot of success using salt brine as pre-treatment on our winter operations, and really we're able to cut our salt usage in half with an enhanced use there and save a tremendous amount of money. So it's good to see this being expanded. But any questions for members of the board? Great. Do I have a motion to approve the FY22 preliminary operating budget?
So moved. Member Carroll.
Harris.
Great. Any discussion? All those in favor?
Aye.
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 Any opposed? Great. Thanks so much, Mr. Brown. Let's move on to the capital budget.
Thank you.
Good morning.
Good morning.
My name is Jeannie Marriott, and I am the Capital Program Manager. I'm here today to ask for approval of the proposed fiscal year 21 to 26 final CTP. The final CTP was recommended for approval by the Capital Committee on November 5th and by the Finance Committee on November 10th. The 6-year budget in the proposed final CTP is $2.8 billion. This is a net decrease of $7.4 million from the draft CTP. To see how we arrived at this decrease, let's turn to attachment number 1, CTP comparison tables, draft versus final, fiscal year 21 through 26 CTP. Looking at the column titled Total 2021 to 2026, on line 1, we see a $1.1 million decrease in the Nice Middleton Bridge Replacement Project. Line 2 is the I-95 ETL Northern Extension. There's a $3.2 million decrease in the 6-year period. Line 3 is the remainder of the CTP, not including the reserves. There's an increase of $154.3 million. In line 4, there's a $157.4 million decrease in the reserves. And then line 5 is just the remainder of the CTP with the reserves added in. In line 6, the total of all changes in the fiscal year 21 to 26 time period is a decrease of $7.4 million. And if you look over to the left in the 2020 column of line 6, we see the fiscal year 20 expenditures were projected at $449.8 million in the draft CTP. But this amount was amended to $465.4 million in September. The fiscal year 20 spending was $463.6 million, resulting in a $1 million underspending of the amended budget. Now, if you will please turn to attachment number 2. This is a list by project of the changes in the total estimated cost and the changes in the fiscal year 21 to 26 time period. The first category is new projects added. There were 4 system preservation projects and 3 enhancement projects added for an increase of $7.6 million in the 21 to 26 time period. Next, there were 6 projects modified to add the construction phase, which resulted in an increase of $107.2 million. There were 2 projects completed with a net decrease of $712,000. And then beginning on page 2 and continuing to page 4 are 89 projects that were modified due to cost changes and cash flow adjustments for a net increase of $37.9 million. And then next you see the reserves that were decreased by $157.4 million. And finally, there's a summary of the project budget changes and the reserve changes that resulted in the $7.4 million final CTP decrease. Moving on to attachment number 3, this chart represents the allocation by facility of the $2.8 billion final CTP. The Kennedy Highway facility is the largest at 36%. This includes the I-95 ETL Northern Extension projects. The Nice Middleton Bridge facility is second at 18% and includes the bridge replacement. Now, if you'll please turn to attachment 4, this shows the categories of projects funded in the final CTP. Safety and capacity improvements are the largest at 37%. This category includes cashless tolling conversions and many projects from the I-95 ETL Northern Extension. Bridge replacements are second at 22%, and this category includes the Nice Middleton Bridge, the I-895 bridge replacement, and bridges that are being replaced as part of the I-95 ETL extension. I'm asking for your approval of the final CTP, and I would be happy to answer any questions you may have.
I have a question. Aren't these tables in the report a little misleading? I'm not criticizing you, Jeannie. This is just a format. Because when the headline is we reduced spending by $7 million, but we really didn't. We just took it out of the bank. We took 150 out of the bank and spent it. And the reserves went down by that much, by 157 million, right? So we're really spending is up 150 million by my math.
Well, the reserves are counted. The reserves are counted as part of the total. So if you move it from one place to another, it doesn't change the overall total. And the $7.4 million is a forecast of what we're going to spend. The only figures on there that are actual are the fiscal year 20. And I'm not sure if that answers your question.
I don't think so. No, I mean, I just.
Member Gaines.
I understand you have to have reserves, but I mean, we're not replacing the reserves. So the reserves going down by 157 million doesn't. I don't think that means that we spent less money. You know,
no, it just said we moved the money that was in the reserves over to the actual projects,
right,
to fund the construction, and we're going to be spending that as shown in the report, and we're just moving the money from one place to another in the budget. It's not it doesn't affect the overall impact.
Right, but I mean, okay, well, I mean, just the headline is that we reduced that the budget went down 7 million, and I just don't agree with that. I just think because we took 150 million, 157 more out of the bank and used it, so that's sort of accounting sleight of hand in my opinion. But
But
I
member
understand
Gaines,
that's a form of using.
the reserves in this sense, it's not, it's the budget, it's not reserves sitting in a bank account. That we have two types of reserves. One is allocated and one is unallocated. And so when a project is funded for PE, we set aside the construction money in the reserve. And so when Jeannie's saying the $157 million reduction in allocated reserves, we funded the construction. So that's why you see the increase in row 3 of 154 million. We just shifted money from, one sub account to another sub account to fund the construction of the project. It's not reserves in the sense of, cash flow that we had saved to the side just in case.
I think it may help too. This is Will Pines, Chief Engineer. I think it may help to just explain the process for one high level second. So with our asset management, we begin by developing a list of projects in what's called the long range needs. And those within our long range needs, there's really high level estimating that's done. It's planning level and a lot of times relies on engineering judgment and just, using past project examples to sort of extrapolate what we think the cost will be. And there is some asset management features that allow us to do some estimating, but it's a very, very rough order of magnitude estimate in the long range needs. The projects, when they move from the long range needs into the CTP, in this case, in this year, it moves into 2026, those estimates typically are not refined until we get closer to construction and we begin to advance the estimating. So that's why we haven't allocated reserves. It's because the estimates are not well developed when they first come into the CTP. As we reach a 60% design level, Jim Harkness at Capital Committee had presented on the estimating workflow and how we allocate the contingencies through the estimates. When we reach 60%, our contingency goes way down, and we at that point feel comfortable with the estimate numbers, and that's when we move it out of the allocated reserves into the programmed CTP with construction funding. So the allocated reserves is part of the CTP, and it does have a line by line programming number for every single project that we're planning to do, but we don't show those numbers early on because, again, we would be doing a tremendous number of updates within our budgeting system if we try to constantly update the estimates all the time before we have any advanced state of design. So that's the workflow at a high level. And I think when Jeannie's kind of talking about moving from allocated reserves into the program CTP, they're all actually part of the official CTP that's on record and submitted.
Right. Okay.
So this is Member Ardinger. Will, so just make sure I understand what you're saying. This reserve was already earmarked for these projects, and what we're seeing is just that we're further down the timeline, and that's why we're seeing the transfer?
Exactly. So
Okay.
once the project reaches 60% design, the project shifts from the allocated reserves into we program it for construction in the system that we call CMAPS, and it shows up as an officially programmed project. And sometimes we have in our allocated reserves, we know, let's take Bay Bridge as a great example, where we converted to all electronic tolling. We had on-call construction projects in the CTP, and we also had a project to do the full highway conversion in the allocated reserves. But we ended up doing, in order to, to comply with the governor's request to expedite that project, we ended advancing some of the funds in the on-call contract to do some of the work sooner, which ended up decreasing some of the needed funds in the allocated reserves. So it's a management tool to allow us to have a little bit of flexibility between how we're using all of the contracts across the program. And it also accounts for how refined our estimating is in the process.
Yeah, I mean, I'm not really critical of it. So in the end, though, the 2021 and 26 budget is going to be 157 more than the other budget. Not to say it's criticism, but based to fund the projects you have coming, it's really going up a little bit, right?
Again, no, because when it depends on what you mean by budget. So if you're saying the programmed projects that are funded for construction, yes, that portion of the CTP is going up, but the allocated reserves is actually part of the overall CTP. It shows up in the number as it has its own pin in the CTP.
Right.
And so those projects are treated as funded projects within the CTP. So when you're looking at the whole total, the answer is no, we're not actually raising the budget.
If you consider reserves a budgeted item, I guess, yes, you're right. Which I guess the way you do it. Very good, thank you.
Any other questions from members of the board? Great, thank you. Do I have a motion to approve the final capital budget in CTP?
Member Ganjemi makes the motion.
Great.
Member Ardinger seconds.
Great, thank you. Any further discussion? All those in favor?
Aye. Aye.
Any opposed? Great, thank you, Jean.
Thank you.
With that, we'll move on to item number 9, which is a board resolution presented by Alan Garman that authorized the cash refunding of obligation revenue bonds.
Great, thank you. We're seeking approval of Board Resolution 220-06, which essentially will allow us to use $53 million of unrestricted cash to set aside funds early to pay debt service. And the purpose of this is to mitigate the severe short-term revenue declines associated with the pandemic. This prepayment of debt service allows us to improve our debt service coverage. And our debt service coverage is essentially net revenues in the numerator divided by debt service in the denominator. And that makes us healthier from a credit perspective. This item was discussed in detail with the Finance Committee at the November 10th meeting, and the committee recommended that the resolution move forward to the full board for approval. This action demonstrates financial flexibility. It helps us essentially improve our credit metrics by leveraging our reserves. And if you think about debt service coverage, it's easy to adjust our operating expenses, relative to changing our revenues in the numerator. And then the agency has some flexibility to adjust our debt service to help us improve coverage. And just going back to 2018, this is similar to an action that we took in 2018. Back then, the agency had $500 million of unrestricted cash that we used to pay down debt, and that was termed a defeasance. And what we're doing now is similar, but it's termed a refunding. And just to understand the distinction is that back in 2018, we had bonds that were currently callable, so we could take the cash and pay off the bonds. In this instance, the bonds are not callable, so it's termed a refunding. So we're able to take the cash and irrevocably deposit it in the trust accounts to pay debt service for the next 2 years. I want to refer you to the table that's titled Refunding Scenario. In this table, you can see the first column says debt service. full BAB subsidy, and that's essentially our debt service, not including planned issuances for the next 2 fiscal years, fiscal 21 and fiscal 22. And the next 3 columns are the principal and interest payments for 3 series of our outstanding bonds, and that's labeled refunding candidates. So for fiscal 21, the 3 debt service payments total 31 million, and a similar amount in fiscal 22 of 31 million. The effect of that is to essentially reduce our debt service by about 27% in both fiscal years. And the revenue effect is essentially double the debt service effect, because the agency is always trying to generate at a minimum 2 times debt service coverage. So by reducing our debt service by 31 million in a year, the effect is essentially giving us a revenue cushion of about double that, about 60 million. An important point to make is that by setting aside the money in advance, there would be no change in our cash available for capital projects or our unrestricted cash position at the end of fiscal 22. And that's because the monies that we would otherwise be setting aside each month to pay for debt service, we wouldn't need to set those monies aside anymore. And so those monies would flow back to our unrestricted cash accounts. So I guess it begs the question that if we know revenues are severely down in fiscal 21 and expected to recover in fiscal 22, why are we proposing to do that for 22 as well? And I think it's that, we are projecting some revenue decline, versus, our last normal year, which was fiscal 19. They'll be down about, the estimate is around 7% in fiscal 22 versus 19. But, I think one of the board members raised, an issue that there's still a great deal of uncertainty. And since setting aside these monies doesn't cost the agency, it just improves our credit position, particularly when we're coming to market with additional financings. It's just, why not take this sort of conservative approach to improve our debt service coverage, given that there's uncertainty about teleworking patterns and leisure travel in fiscal 22. The second table that's shown in this item shows the improvement in coverage. So for fiscal 21, it would improve our debt service coverage in theory from about 2 times to around 2.7 times. And, in fiscal 22, we're showing healthier coverage as revenues are projected to rise, but we would still improve coverage from around 2.8 to around 3.7 times. Some final points on how this is perceived by bondholders and credit rating agencies. The agencies have come out, and there have been many issuers, both in the toll sector and also other types of municipalities, that are taking similar actions. They're either using cash to pay down debt, as we're proposing, or setting it aside early, or restructuring their debt, where they're sometimes it's termed a scoop and toss in the market. It's essentially extending your debt service. And so what they're doing is they're issuing new bonds and restructuring their debt to extend or lengthen their average maturity. And importantly, the MDTA is not proposing to extend our debt maturities. We're just simply proposing an early set aside of funds for debt service. The rating agencies have said that, normally in a normal market, they wouldn't like to see an issuer extending debt maturities, but they've called that, more severe, strategy prudent in light of COVID-19. We're taking an even more conservative approach, relative to a debt extension. We're just simply setting aside funds early, and, they've also indicated that that's, prudent and favorable approach to give yourself some cushion and improve coverage. In terms of one other point I failed to mention in the table above was that The sum of the debt service refunding is 63 million in the table, and we're only proposing to use 53 million. And that's because the agency is required to set aside funds in monthly increments, essentially 1/12 increments. And we've already made the set aside for the July through October period. So we've already set aside about 10 million in those bond service accounts. So we're just picking up the remaining 53 million. And we would expect that if this is approved, that we would make these transfers, this month in November, and those accounts would essentially be fully funded for debt service for the upcoming, or for the 2 full fiscal years. Are there any questions?
Let me just first say, the health of the board, but any questions from members of the board? Great, thank you, Alan. It certainly improves the health of our financial position in a pretty uncertain time. So I certainly
this is Member Jimmy. I'll move for approval.
Great.
I'll second it, Member Gaines.
Great. Any further discussion? All those in favor?
Aye.
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 Any opposed? Great, motion carries. Thank you, Alan.
Thank you.
At this point, we'll move on to 2 items. One is an approval item on the financial forecast, and one is biannual review of the revenue sufficiency from Deb Sharpless, and then we'll go into a short break. So go ahead, Deb.
Thank you. Members, in your materials, you have your summary memo as well as the financial forecast. When presenting this item, I'm going to refer to the actual forecast. It's the table that has the various colored rows in it. So this forecast incorporates all of the items that we've discussed, starting with item 5 with the traffic and revenue. These numbers are the updated November 2020 traffic and revenue forecast. In the operating budget, which is where the blue lines start, the operating budget for fiscal year 2021 is the amended budget approved earlier, as well as the FY22 budget that was approved, and then the standard growth factors that we've always incorporated into our forecast for future years. The debt service in fiscal year 21 and 22 reflects the cash refunding. That's why you can see the decrease in those years, and then it goes back up in fiscal year 2023. That's found right below the operating budget amounts. Then you see our net position, which is simply the difference between revenues and expenses. Next is the capital program. That is the capital budget presented by Jeannie by fiscal year. And then the next section is our sources and uses. It'll reflect a bond sale that Alan will address in a few minutes in fiscal year 21. One of the things that I'll note is you see in fiscal year 22, we do not have a bond sale. We have shifted out the TIFIA loan by a year, and we pulled the balance of the money into fiscal year 21. So that when you look at those 2 years combined, our bond sale is the same amount except for funding a debt service reserve. Then you see the $63 million. That's the cash refunding that Alan just spoke to. Now this amount is the full 63 million and not the 53, because up above on the debt service lines, it was reduced by the full 63 million. And that's why we need the 63 down below. And then we get to our total cash position, which is the green line. Next, I want to focus you on the peach color section. These are our financial standards. The first of them is our bond cap. We have a $3 billion bond cap. And when you look at each of these years, you see how we are below that bond cap. Next is our unencumbered cash balance, which is $350 million. And you can see in each of these years, we stay either at or above the 350 million, with an emphasis of staying higher particularly in 21, which I will circle back to in just a second. The next line is our debt service coverage. We have a requirement of 2 times coverage, and you can see that we are above, and basically 1/10 point is roughly $10 million. That's where the $70 million comes from. So revenue could go down. Well, I should say net revenue, because if revenue decreases and operating expenses also decrease, it's a net. But if operating expenses stayed as forecasted, but revenue decreased, we have $70 million of room to still maintain our 2 times coverage. And then you can see in fiscal year 22, our coverage is much stronger. We're at $3.7 million. Again, as Alan spoke to, there's no negative impact to us to do the refunding. And so why not do it and reduce some of our risk? And that's why we have this such high coverage in fiscal year 22. And then lastly, you see our rate covenant, which is a 1 times coverage, which we are well above throughout the financial reporting period. Now, with regard to unencumbered cash balance, I would ask that I'm seeking your approval of this forecast, but recognizing that I may come back, or we may come back next month and revise only the unencumbered cash balance amount. 394, we feel very strongly is a floor. We have moved to a new financial model, and we are having a little bit of difficulties when it comes to encumbered and unencumbered cash balances. But we took a conservative approach and reported the lower of the amounts for unencumbered. And so either the forecast will say exactly as is, or there's a possibility we'd come back in December where unencumbered cash would be higher. So if we did come back, it would be a stronger forecast. There is not a risk of a weaker forecast. So with that, are there any questions that I can answer?
Thank you, Deb. Any questions from members of the board?
Mr. Chairman, this is Member Von Paris. I just have a couple of comments. I think that Deb, we all very much appreciate the hard work and effort that went into this. The plan and the forecast, especially during these challenging economic times. And we thank you for that, for sure. And I know Member Rosen already discussed the concerns about the COVID and potential surge, I believe. I think as it relates to some other, our transition with our vendor transition, I think it's important that we have some modeling in place. And certainly, I'm sure we already do, but some potential cost reduction modeling in place. If X happens, what do we do? And just as a proactive measure, and then the monitoring of our that transition and the impact, the potential impact on revenue, our revenue stream, I think is very important. And I know that we've talked about that in many meetings, all of us have. So about at the board level. So we appreciate that. But again, thank you for the great effort. And I know it took a lot of effort to put this together, you and your team. Thank you.
Thank you, Member Von Paris. Deb, let me echo Member Von Paris's comments as well. My appreciation for the whole team. I know this has been pretty challenging from a variety of perspectives, and the financial forecasts are just another challenge in this. So, any other questions from members of the board? Great, thank you. Do I have a motion to approve the financial forecast?
So moved. Member Rosen?
Second, Member Carroll.
Great. Any further discussion? Those in favor?
Aye.
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 Any opposed? Great, motion carries. So thank you, Deb, and please thank the whole team on behalf of the whole board. just kind of go out on a limb there and just say on behalf of the board, just the whole team to, I know this has been a real challenge for everyone working through this, so thank you.
I certainly will.
Move on to item number 11 with Deb, which is the biannual review of the revenue sufficiency.
So for this item, this is a board policy that requires the biannual review. Basically, I'm answering the question, do we expect sufficient revenue to adhere to our standards, or do we need a toll increase? And this item goes hand in hand with the financial forecast. On page 2 of your summary memo, you can see a table that looks at our rate covenant, our unencumbered cash balances, as well as our debt service coverage. And when we maintain our standards, so we are above 2 times coverage, we will always, if we were ever to drop below one of these standards, we would always drop below debt service coverage prior to the rate covenant. So when you look at the debt service coverage, you see that we stay above 2 times coverage throughout our reporting period, and that's how you know we do not need a toll increase for our financial reporting period. So in this summary memo also talks about revenue and operating expenses, and considering all of the items we just went through, I won't walk back through all of that.
Thank you, Deb.
This
That's
is
some news, but go ahead.
This is just an update item, so no approval is needed.
Absolutely. Thank you, Deb. No, so the news that we certainly don't need to entertain a toll increase is welcome news at a time when, a lot of people out there are hurting financially. So it certainly would have been very challenging otherwise. Any questions for members of the board?
Looks like we're kind of tight on the unencumbered cash in out years. I guess that's a conservative budget there, Deb.
That's because we're in a cycle of issuing bonds. And when we strategically, when we built the ICC and the first part of the express toll lanes, we went through a number of years where we were issuing bonds on a regular basis. And then we've had an extended period of time where we've issued no bonds until last year. And I'm referring to new money, not refunding existing. And so now we're going through a period of time where we're issuing bonds again. And so we only issue bonds to the extent needed to maintain our unencumbered cash balance. Because when we have, when you have 2.7, 3.7, part of the capital program is paid for with our unencumbered cash funds, because anything above 1 times coverage is money that's available for the capital program. So we spend that down to the $350 million mark and then only sell bonds for what is remaining. And so that's why you see us staying at the 350.
Right, anything above that is wasted in a sense. It's just sitting there.
Yeah.
Right.
Yeah.
We're financing money to sit it in the bank.
So you're really targeting that number. It's not really like we're scraping by. That's the intention. I got it.
When we're issuing bonds, yes, we're targeting that number.
Right. Very good.
Thanks, Deb. Any other questions for members of the board? Great. Well, thank you. With that, we'll take say it's 10:43. I was going to say just take a 5-minute break, but let's come back at 10:50. We'll just take a quick break. they see you have a break, they like coming from 6 different directions with 1,000 questions. So great. But Natalie, do we have, oh, great. Looks like Alan's there. So with that, we'll just move on. Really, items 12, 13, and 14 back with Alan Garman. So go ahead, Alan.
Great, thank you. The next item is Board Resolution 20-07. We're seeking delegation of authority to begin the process to issue approximately $400 million of toll revenue bonds to finance capital projects for an approximately 15-month period through the end of fiscal 22. The sizing is consistent with our last June forecast. I think Deb explained that. But as you get close to a fiscal year end, it just makes sense sometimes to combine the financing needs for the remainder of fiscal 21 with the needs for fiscal 22. The forecast is just really a placeholder, and then as you get close to these key events, you would adjust sizings and the timing of issuances to optimize the financing rates. The TIFIA financing is essentially a rate lock mechanism. So we had modeled it for fiscal 22. We've known for, several years of planning purposes that we would likely defer the TIFIA draws toward the end of the Nice Bridge project. And that's because once we sign the loan agreement, we will be able to lock in the prevailing treasury rates. And if we're in a rising rate environment, we can use that rate lock as a hedge. So it would make sense to move the municipal financings forward and to defer that TIFIA loan draw as long as possible. The bond par in this instance is $400 million. That doesn't account for bond premium or costs of issuance or debt service reserve funding. So we'll be adjusting that sizing downward to account for the bond premium, but net of the debt service reserve funding and costs of issuance. In the one table that's included in here, you can see what the total financing needs were back in the June forecast. The combined fiscal 21 and 22 was about $380 million. And what we're requesting now is $400 million. The key reason why it's gone up is that we were modeling a funding of our debt service reserve requirement with an insurance policy, but the market for surety policies is not very good right now because of the pandemic. And just for perspective, we had bought 2 surety policies back in 2018, and the quote that I received recently is 5 times the cost of what we paid back in 2018 in terms of premium. So, we're looking at cash funding, at least temporarily, that debt service reserve. So that accounts for the approximately $20 million difference between the June and November forecast. So we're seeking approval of Board Resolution 20-07. Are there any questions?
I have one, Chairman. Can I go ahead?
I'm sorry, I was talking on mute. I have one question, but I'm going to go to the board first. Go ahead, Member Cox.
I have one, Alan. Are the rates at this point holding steady as far as refinancing, or even issuing new bonds?
Yeah, I would characterize them as extremely attractive historically. We had some fears when we came into the market in June. We were gearing up for that financing several months prior, and we were worried that, there was a lot of dislocation in the muni market where, they were selling in from municipal bond funds. So they had a lot of fund outflows, and we were worried that, credit spreads would widen and there wouldn't be enough buyers. But by the time we came to market, things had normalized and flows had started to return to municipal bond funds. So, our financing rate, if I recall correctly, was extremely low. It was around 2.8%, and on a yield to maturity basis. But on a yield to call basis, it was, around 1.8%. So extremely low historically, for this agency. So, rates have remained low. I think the anticipation is that, rates could trend higher, particularly if there's a better outlook for, a vaccine and the economy recovering. The Fed has indicated that they're very much on hold, but, the yield curve could steepen with longer rates rising and short rates remaining low. But, we can't really time the market in terms of our issuance. We need the money when we need it, but, we can congratulate ourselves when we, our capital project needs are in sync with a recession or a pandemic, or, it's happened to us twice now with the big financial crisis back in 2007 and 8. The agency really benefited from low rates. And, here we are again when our financing needs are the greatest and the market is in upheaval, and we're able to take advantage again.
Thank you.
Any other questions from members of the board?
Yeah, Alan, I assume we're going to continue to evaluate whether a surety bond option is part of it.
Yes, we had come to the board back in 2018, and I presented sort of the rationale, the financial rationale for cash funded reserves versus surety policies. And, clearly, I think over time, it's much cheaper to just buy an insurance policy. So, we may come back and discuss that internally, but it's just kind of a little bit unpalatable to pay 5 times the normal rate. The quote that we had paid actually in 2018 was 1.25% of our funding requirement. And we compared that to the carrying cost of our debt, essentially the difference between what we were financing at and the earnings that we were getting on the debt service reserve monies. And so we looked at that annual carrying cost and then compared it to what would it cost to buy the insurance policy and what were the carrying costs over a 10-year period. And was strongly in favor of buying the surety policy. It's still in favor of buying the surety policy, but you just wonder if, will rates normalize in 12 months or 18 months, and does it make sense to cash fund initially, and then we can always go back a year from now or 2 years from now and replace the cash funding in the debt service reserve. That cash would get released and be available for the capital program. And then we could just simply buy an insurance policy, but maybe at like half the cost or a quarter the cost of what they're quoting us today. So we're definitely thinking about that. In the forecast, we've modeled this near-term issuance with a cash-funded debt service reserve, but for out years, we've modeled surety policy purchases. So that's our thinking of what we'll be doing in terms of a best guess, in coming years.
Thanks, Alan. Any other members of the board? Alan, I had a similar question to Member Cox, where I think the interest rates on TIFIA are about as good as I've ever seen them right now.
Right.
And so, just wanted to kind of get your thoughts on that and that kind of deferral there and kind of our ability to take advantage of today's rates if we defer too long.
Yes, so our goal is to work as aggressively as possible to sign the loan agreement, and that's the big trigger for being able to lock rates. So by showing a deferred draw, that doesn't equate to when we're locking rates. So like if I could lock the rate today, I would, and we could just draw it a couple of years from now. So we're in the process. We've been in the process with the Build America Bureau for over a year now. We've talked to our advisor and peers, and the process is very lengthy. And I think it's been a little bit complicated by the pandemic and potentially change in administrations at USDOT. But our goal is continuing to be to lock it in as soon as possible. For perspective, we had locked our previous TIFIA financing rate in December of 2008, and we locked it at 2.56%, which at the time was within maybe 4 basis points of the all-time low in the 30-year Treasury rate. So we were thrilled with that. And then in subsequent years, there were a couple of times when it dipped below that. But for perspective, I mean, the 30-year Treasury is around 1.58% right now. So it's well below where we locked in back in 2008. And two other developments for us that are very favorable is that we're exploiting a provision in the federal law that would allow us to refinance the old TIFIA loan if we can apply some of those savings to the new loan. So that's something that I don't think was widely understood in the market, and we had explored that early on with them. So not only are we trying to get this new money financing, but we're trying to lock in a refinancing, and you'll see that in the next agenda item about the projected savings on that. So I can't wait to lock, and we're doing everything we can to lock as quickly as possible. But once we lock, then we'll have the comfort of waiting to actually draw the money and do the muni financings ahead of the TIFIA loan draws.
Yeah, absolutely. Those savings can be significant. With that, do I have a motion to approve the board resolution?
So moved. Member Gaines.
Member Jimmy will second.
Great. Any further discussion? All those in favor?
Aye.
Aye.
Any opposed? Great, motion carries. Let's move on to the next one, Alice.
Okay, this is Board Resolution 20-08, and this is for our TIFIA financing. The main purpose of this resolution is just to extend the working authorization deadline. It was set to expire December 31st, and we clearly need more time, so we're requesting, or USDOT needs more time to approve us. We're requesting an extension to August 31st. I'm hopeful that maybe sometime this spring we can get through the process. The steps are essentially, a letter of interest, then they invite you to begin the credit review process. And that's the process we've been stuck in, is the credit review process. And in parallel with that, we've actually been working on, the draft loan agreement. So that's a heavy lift for, our bond counsel and AG's office on that. So once we get through the credit review process and we get agreement on the loan agreement, then we can sign that loan agreement and lock in the interest rate. We had two prior resolutions that were separate. One was for the new money TIFIA loan, and one was for the refinancing. And so just to streamline, and we're just combining those two resolutions into one as well. But the key purpose was really just to extend the working deadline. The refinancing portion, we had borrowed $516 million back in 2008 and drew it over several years. There's $482 million remaining on that loan. So that will be the refinancing portion. The new money portion is a function of approximately a third of the cost of the NICE bridge. So it's around $210 million. So combined, we're requesting in this resolution authority for approximately $700 million. Back to the earlier question on the projected savings, they're significant from the refinancing, approximately $50 million, but there's great uncertainty regarding the treasury rates and volatility. And just for perspective, since the beginning of October, the 30-year treasury has moved up and down by about 30 basis points. So it's been as high as like almost 1.75%, and it was as low as in the 140s. And today it's around 158. So one other great development for the agency is that in previous years the loans were locked in at the 30-year treasury rate, and we've been able to get some agreement with the Bureau to allow us to break up the loan into tranches or pieces. So some of the loan will be tied to the 30-year treasury rate. Some of it will be tied to like the 20-year treasury and the 10-year and the 5-year. So for perspective, the 10 years below 1%, So we'll be able to get a blended rate that's well below the 30-year Treasury rate. The resolution, there's a few key points. I'll just run through it at the bottom of this item. The current loan is continuously callable, so we could refinance it in the tax exempt market, or we can try to refinance it with TIFIA. In this case, it's not economic to refinance it in the tax exempt muni market. The loan amount is $482 million. The financing rate was 2.56%. The expected savings on this, as a percentage of par, I've got in here a range of 4% to 15%. And I apologize for the huge range, but the market is just so volatile that it's hard to give you a sense of the magnitude of the savings without giving a range as opposed to just an amount. So, if you think about the 30-year Treasury at 150-ish%, I modeled that savings between 1.25 and 2.25% to give you some perspective. So the nominal savings at the low end of that range, it would be only 25 million, and at the high end of that range, meaning like a lower blended financing rate, would be $100 million. And there's approximately 27 years left on that loan term. So again, we're targeting a loan signing, hopefully in the spring of 2021. The resolution contains limiting provisions. Par amount would be limited to 700 million. And in order to do the refinancing piece, we'd have to have net present value savings of at least $1 million. But hopefully that's closer to $50 million, depending on when we can execute. The final maturity of the refunding portion is no later than the final maturity of the existing loan, so that's 2047. And this resolution would give us some working authorization to August 31st. And then with all of our financing resolutions, we're required to come back to the board at the first meeting after the financing occurs. Are there any questions?
No questions for me. Any questions? Great, thank you. Do I have
It's Member Jimmy. I'll move for approval.
I'll second that, Member Carroll.
Great, thank you. Any further discussion? All those in favor?
Aye.
Aye.
Aye. Any opposed? Great, thanks. Motion carries, and we'll move on to item 14, the quarterly review of the investment strategy.
Great, thank you. This is our normal quarterly update on trailing 12-month performance and strategy recommendations. The only, new element of this presentation is that we're making a recommendation to extend the duration and average maturity of one of our accounts. If you recall, back in February, we went through the finance committee and then the full board and sought approval to extend duration for our full unrestricted cash position. And then COVID-19 hit and interest rates dropped to all-time lows, and we came back to the board the following month and said we don't really want to reposition the entire portfolio at record low interest rates, so we'd like to place that on hold more or less indefinitely. And so we've been coming back periodically and updating the board that was still our continuing position. Interest rates have come up off the all-time low a bit, but we've also, been conscious that the whole point of the recommendation was to, accept greater return volatility for, higher returns over a very long period of time. And so rather than trying to time the market, we're advocating for a duration extension of not the entire unrestricted cash position, which sits in the general and the M&O reserve, but only the M&O reserve. So that M&O reserve account is about 14% of the unrestricted cash position. So I'll get back to that in a minute, but just to start off really is that for the trailing 12-month period that ended September 30th, our strategy was in line with the investment policy, and our portfolio's total return was in line with the benchmark index. The investment committee is recommending the implementation of that duration extension for the M&O reserve and a continuation of the current strategy for all of the other accounts. The one other account that's worth mentioning is that with the financing last year, we had funded in June, we had funded a $30 million debt service reserve. Our strategy for reserves had been to invest those monies out a bit longer than our unrestricted cash accounts. And, we came to the board and said, we really don't want to purchase those or longer term securities with that $30 million reserve in the midst of these record low interest rates. And so we just adopted a shorter term structure with the board's approval. And the other component in that decision and recommendation was that we're still considering purchasing a surety policy. And in the event that we do that, we would be able to release that cash from the reserve and move that over to essentially fund capital projects. And we didn't want to lock up those monies in long-term investments if we were going to be purchasing a surety and releasing it near term. So the recommendation for the debt service reserve is to continue what we had recommended before, which is just to remain short in that account. And the recommendation for the general account is to remain with our current benchmark, which is a 1 to 5 year index. The investment strategy section here is we have two general strategies for our types of accounts. One is considered matched funding, and that's something that we use for our capital accounts and our debt service accounts. And that's essentially, we're trying to match our investment maturities with the known cash flows. So since we pay debt service semi-annually, we can match up those investments to those semi-annual debt service payments. And for the capital accounts, we have some projections for capital spending. So we keep those investment maturities, to coincide or be slightly shorter than those projected cash flows. For the unrestricted cash accounts, where we have these very long-term reserves, and the purpose of that $350 million reserve is to deal with contingencies, but also, most importantly, it's really to hold the AA credit ratings. The rating agencies expect you to have, long-term cash reserves. We don't typically need to dip into those reserves, and really this COVID-19 was the first instance of dipping into it in, more than 10 years. So when we invest those monies, we consider them on a total return basis. We're looking at the risk return trade-off of a longer term strategy, in terms of the volatility of returns against, achieving much higher average annual returns over multiple years. So for our general account, we have a 1 to 5 year benchmark. It has a duration of approximately 3. And the proposal that was previously approved back in February for the M&O reserve was to extend that out to a new benchmark. And our benchmark was essentially a composite index of 1 to 13 year treasury strips. And that index approximates the effective duration of a laddered portfolio from essentially 6 months out to 15 years. And that would lengthen the average maturity of the account to about 7.5 years from the current level of 3 years. And the duration would go from approximately 3 out to 7. In terms of the performance and benchmarking, we're primarily focused on those accounts that are managed for total return. The matched funding accounts are really just, we're doing as well as we can based on prevailing rates. So for the capital and bond service accounts, they're quite short. For the general and M&O reserve, our total return performance for the trailing 12 months through September was in line with the benchmark index. We returned 4.93%, which was very much in line with the composite index return of 4.99%. We were slightly short the duration of the benchmark through that period, so that's why we slightly underperformed. So I guess I'd love to open it up to questions, and also the request here is to approve, I guess, the previously approved duration extension, but in this case, we're not asking for an extension for all of the accounts, just the M&O reserve, which is about 14% of the total unrestricted funds, and we're recommending to remain on hold for that duration extension for the other $300 million in the general account. And in terms of the speed of implementation of that, is that, I think there was some discussion about, muni financing rates. The agency can buy taxable munis in its portfolio, and there have been some relatively attractive opportunities in taxable munis. So, there's going to be heavy issuance this year from the muni market, related to the financial crisis. And I think we can take advantage of some opportunities to buy some taxable munis that have yields that are above comparable maturity agencies. So for the M&O reserve, we would be looking to kind of slowly extend that duration out toward the new benchmark target and try to look for opportunities, as rates rise and potentially rise in coming months. And also, as there's heavy muni issuance, we might be able to pick up some attractive new issue taxable munis with spreads over agencies. Are there any questions?
No questions from me, members of the board? Great, thanks, Alan. Do I have a motion to approve?
So moved, Member Rosen.
Second, Member Von Paris.
Great, thank you. Any further discussion? All those in favor?
Aye.
Aye.
Any opposed? Great, thank you, Alan.
Thank you.
Move on to an update item with Jeffrey Brown, our quarterly operating budget comparison.
Hi, this is Jeff Brown again. I'm here to provide an update to the year-to-date spending for the full year 2021 operating budget. As of September 30th, we were at 15% spend of the budget as compared to a target of 23%. With the exception of 3 objects, all other objects were significantly below budget. The 3 objects not below budget were communications, salaries and benefits. Those 2 were essentially at budget, and the additional equipment, Object 11, was well above budget, and that was due to a timing of when HR scanning equipment was expensed. It was expected to occur in the prior year. It actually occurred this year. I can talk a little bit about that in a little bit. As mentioned, all the other objects were significantly below budget. There's really 4 major areas that kind of repeat throughout this analysis. One is the timing of invoices when they came in. Second is seasonality. Some expenses or some objects typically have heavier expenditures at different times of the year. Ongoing COVID-19 impacts and specific management actions that may have been undertaken. So looking at some of these objects, travel was well below budget. This is still limited due to the COVID-19 pandemic. Travel's been well down. Fuel and utilities are well below budget at 10% spend. These are typically, this is a seasonality effect. These are typically heavier in the winter months. Plus, we're still in delay on these as well. Vehicle operations and maintenance, Object 7, was well below. Again, higher spending usually is in the winter plowing seasons. Also, new vehicles typically, and we have newer vehicles now, have less maintenance. And there was a COVID-19 activity reduction in this object as well. Contractual services are well below budget. Now, some of the sub-objects accounting for this variances are as follows. Advertising was well below, primarily due to the 3G 3G go live update delay. Plus, there's typically summer campaign expenses which occur later in the year. Building repairs and maintenance, it was only at 15% spend. Again, heavier expenditures usually in the third and fourth quarters. Training is at 10%. There's been a focus on reducing these expenses. In addition, things going online typically reduces travel associated with this, so costs are down as well. Management studies and consultants are at 12% spend. There's been a focus at reducing these costs and only spending on them as needed basis only. Security services is down as well. Typically, service repair requests is what's driving this. Things on like scanners and security cameras. Fiscal services is at 7% spend. Easy Pass retail fees are down. That's associated with the reduced traffic associated with COVID-19, and you have less credit card processing due to the delay in NOTDs. Then really the next three bullet points are all have the same underlying cause, which is really timing. You have the IT contractual services, which are sub-objects 841 through 869, Easy Pass Service Center costs at 873, and other contractual services, sub-object 899, are all down, all due to the timing of invoices of when they've been coming in. On Easy Pass, the first set of invoices came in at the end of October. Object 9 is well below budget at 8% spend. The big ones, Easy Pass transponders is at 0. We're working off pre-existing inventory, and we do anticipate to reduce these costs, and this was an item in the amended budget for reduction. Salt, pretty obvious, that's a seasonal expense, so there's very little no spending in that at this point. Roadway maintenance is well down as well. Lower traffic volume, limited maintenance activities have reduced this expense. Replacement equipment, object 10 is well below. We do have equipment that is expected to be ordered, but not until later in the year, so those expenses are showing down at this point. The one object that's up, object 11, as I mentioned before, there were some HR scanners that were previously expected to occur last year, but they didn't occur into this year, and they were expensed in this year, and that drove the. And then finally, fixed costs were down, and that's insurance payment premiums. Typically, those don't occur until the second and third quarter. So again, a lot of timing and seasonality effect is driving the lower costs for the year-to-date expenditure. That concludes my update. Happy to take any questions at this time.
Any questions from members of the board?
I have a question. Accrued leave, let's see, I think it was accrued leave payments were way up. And I don't know what this other item is, miscellaneous payroll, AI, artificial intelligence. Those two items were, I say, were 450% of the year. One of them is 650% of the other. Any reason for that, or?
I don't know. I'd have to go specifically to look that up. I don't have that in front of me as to why those would be specific.
So, Member Gaines, this is Chris Thompson.
Hi, Chris.
The accrued leave payments we don't generally budget for because a lot of times we don't know when somebody's retiring. And if they retire in mid-year, we've got their salary there to cover the accrued leave payments. So we really don't budget for it. That's why you'll see it's over budget.
So the salary goes down and the leave goes up, I see. So
Yeah.
What is it? Okay. And the other item was a miscellaneous payroll AI. I'm not sure. Budget 137,000. It was 621 spent.
Can
no
you
ideas
tell
on
the object number?
item number is 010110.
Okay, miscellaneous. Oh, okay. That what hit that this year is the premium pay for COVID that the police were getting.
Oh.
We did not budget for that. Weren't aware of it.
Right. All right. Thank you.
Any other questions from the board?
Are the expenses associated with the 3GL delay incorporated into this budget?
I believe so. They should be, yes.
And what line items would they be? Would that be consultants?
Well,
I guess.
I'm sorry, the advertising obviously is going to be in there. Where the other portion of that is, I don't know right offhand. I'd have to see what those expenses occur, but I don't know that offhand.
Give me 1 second.
Member Rosen, it's object 873 is the Easy Pass Service Center costs. Is what we pay to Conduit and will be TransCore Caption.
I thought we have some additional costs for oversight and our advisors working with us. That's also in that line item.
So the consultants we're using for oversight are charged to the capital budget during implementation.
Okay. Thank you.
Great, thank you. Any other questions from members of the board? Great, thanks, Jeffrey.
Thanks.
Let's move on to item number 16, the first quarter capital budget comparison with Jean.
Good morning. I'm providing an update on the actual fiscal year 21 capital spending against the fiscal year 21 capital budget in the fiscal year 21 to 26 draft CTP. This information was presented to the Finance Committee on November 10th. Capital spending in the first quarter was $77.2 million, or 14% of the budget of $543.4 million. The first quarter percentage is typically low because there are outstanding accruals for work completed in fiscal year 20. 85 of the 105 projects budgeted in fiscal year 21 were within the acceptable spending limits of 0 to 50%. Now, if you'll turn to attachment A, this table shows the 7 projects that are budgeted for more than $10 million each in fiscal year 21. The largest budget is the Nice Middleton Bridge replacement at $198.6 million. Spending for this project is at 12% through the first quarter. The fiscal year 21 budget for these 7 projects combined is $46.4 million, which is 60% of the total program spending of $77.2 million. This is an update, and that's completed. I would be happy to answer any questions you may have.
Thank you, Jean. No questions for me. Any questions from members of the board? Great, thanks so much.
Thank you.
Let's move on back to Deb for a quarterly update on traffic and revenue.
Thank you. This is a quarterly update on traffic and revenue. It falls into like 3 pieces. I'm going to focus on the latter part of these 3 topics. First, it talks about COVID. Then it gives a message that traffic and revenue is below this time last year, which is what we would all expect because this time last year we didn't have COVID. And then it looks at where are we in relation to the financial forecast. And that's the area that I'm going to focus on. And for this item, we gave you a copy of the quarterly update from CDM Smith. And I'm going to refer to tables 8 and 9. I'm sorry, 8, 9, and 10. So table 8 can be found on page 16 of this report. Let me advance myself. Okay, so the table 8 is our legacy transactions, and the report's broken down between ETC, also a lot of times Easy Pass, and video transactions. Now, this is the not transitioning to the new system. This is where monitoring this at this point in time has been challenging. We're working on additional reports to be able to monitor and report in a better format for upcoming meetings and as well as for our internal use. But one of the things you've always heard me say in the past is what's important is where are we in relation to our forecast? And you can, it says that we are below the forecast. Now, the reason that we're not panicking here at a staff level regarding that is because we know what's causing it. When a customer travels, transactions go initially into one of two categories. They're either an electronic, we call that an e-toll, or they're a video toll, which means that they have the potential to be a video toll. So e-tolls or image tolls, they have the potential to be video tolls. But sometimes customers travel and they're Easy Pass customers, but they didn't have their transponder properly mounted, or the transponder might not be in their car or in their glove box. And when that happens, that's called an I-toll. And so right now, the I-tolls are sitting in the image bucket and they haven't been processed yet as ETC. We know that is causing this difference. What we don't know at this moment is when we account for the I-tolls, how much will it adjust us? You know, initial reports has 35 to 45% of image transactions are actually I-tolls. If that is in fact the case, then we expect to recover all of this, if not more. And that's the further analysis, and that's where we have to come back to you. This is caused because we took image transactions with the anticipation of transitioning. We had moved those and they stayed at CAPS, anticipating being transferred to TransCore. Well, we have since been moving the transactions over to Conduit. We're working through moving them on the July transactions now for them to be processed. But that's what's causing this. And we'll be able to come back to you with additional information to be able to show those transactions being processed, as well as reconcile any I-tolls that belong in the ETC bucket, which will bring us closer to where our forecast is. And then the message is exactly the same for table 8 transactions. Table 9 is revenue. It's the exact same calls for revenue being down from the forecast is the processing of I-tolls. And then on table 10 is transactions and revenue for the ETL. And that's the same calls as well as the I-toll transactions is what we believe that to be. Now, ICC transactions are not included in this report, and that's because all ICC transactions were held by CAPS at our direction because we anticipated trip construction occurring with CAPS and then moving to TransCore. Those transactions also are being shifted over to TransCore, and we'll be able to report on them in the coming months. So this update, you know, we were posed with the question, do we show and share with what we have, or do we hold back and wait until the I-tolls are reconciled and we bring information to you later? We opted to share with what we have now, recognizing that this is definitely an impact of not transitioning yet, that our visibility isn't as clear as we want to, and we're working on alternative means in order to be able to garner this information. Another piece of why this isn't alarming to us at this juncture is when we were looking at COVID transactions before, from a transaction basis, we're where we expect we are where we expect it to be. We have been stable since July with the levels of revenue. You're not seeing declines, any sharp movements. And so from a transaction basis, we see we're where we need to be. These transactions that are reported on these pages, these are paid transactions. So when I talk about traffic, the raw traffic is where we had forecasted. So once we process these transactions, they should also come in line with the forecast. Can I answer any questions?
I got one. How quickly do you think we're going to have the I's moved over to the E's?
We're moving transactions now. These transactions weren't designed to go to conduit. We work them through a black box. It is labor intensive. People work on that on a regular basis. So as we send them, we then go back and reconcile them to make sure that all transactions moved over. We are in the middle of July. We've moved those over. So it's I'll be able to report more information. What I can tell you is the transactions that Conduit are processing, the mailing of notices and the processing from when we held notices, we're not holding them up. They still have transactions that they're processing through June. And so as we move these, Conduit will not be at a place where they're waiting for transactions.
If they're, and this, I'll try not to ask too many more questions, but I know it's all related to your future report too, with EasyPass, 3G. So they're in July. Are we continuing to get behind if we're still back in July because we haven't done the transfer?
Let me first restate.
Ooh, feedback.
Yes. Let me restate the question first to make sure I understand. You're asking if our backlog is continuing to grow.
Yeah, basically.
Yes. So I need to look closely at the numbers. I believe the answer is not. Definitely when we are at 1.8 million transactions of NOTDs going out, the backlog is declining. So when we reach that point, it's steadily going down, and that's how we completely catch up into fiscal year 2022. I need to double check if at 1.3, which is where we're at right now, if that is causing a decline or it's current volumes. I think it's closer to current volumes.
Thank you. Did that answer your question?
I think so. I'm just concerned that we're being, the transfer happening, impacting us in quite a few ways.
Sure. No,
we'll
absolutely.
get there.
Absolutely. Any other questions from members of the board?
This is Member Ardinger. Deb, I actually had a two-part question. First of all, do we have any rough estimate of what the I-tolls are that are unaccounted for?
That is what we are currently working on. when we take the raw transactions, this was in June time period, we were accounting for a 45%. Further work needs to be done in that area, and that's why I'm not reporting at this time, converting estimated ITOLs into transaction revenue. It is something that we will come back with. It's something we're actively working on right now. Don't have enough information with a level of confidence high enough to be able to report that.
Okay, and then second part to that is, if I understand you correctly, the assumption or the hope is that the majority of those ITOLs are tied to an easy pass. And if they are tied to an easy pass, that makes the collection of them more certain, 100%?
Yes.
Okay.
Yes. And all ITOLs are tied to an easy pass. I mean, there is a possibility that account could be inactive, but what our process is when someone travels and if we don't have a transponder read, the first thing we do is we take that license plate that we captured and we match it against all Maryland Easy Pass accounts to see if there's a match, and that's an ITOL. The second thing we do is we take that license plate to the rest of the Easy Pass network and we see if they have the plate. So an ITOL is where we match the plate to a plate on an Easy Pass account.
And then and I'm sorry, this is just for my own knowledge. With an Easy Pass, like my Easy Pass is tied into my credit card. So the thought is that these are pretty much going to be collectible.
Yes.
Okay.
That is correct.
Thank you.
Great, thank you. Any other questions from members of the board? Great, thanks a lot, Deb. I think we want to move on to the 3G item.
So for this item, last month I gave a verbal update, and the update focused a lot on, where did we start? What has been our struggles and challenges throughout the transition, and where are we today? This update is focused more on where were we in October when I reported out, and where are we now? And our plan is to continue to provide monthly updates to the board members on this transition. So referring to the PowerPoint slide, the first thing is about approach and schedule. The schedule, it's 100% task-based. There's no date restraints in it. And, we call that a true plan. We've had allocations of time to different tasks. We just think that the current approach is continuing to refine the scheduling to try to make it more reliable. Critical tasks are sequential, so we're pulling critical tasks up earlier, even when we deal with testing. We use the term core functionality, and that core functionality or the backbone of the system, that is, each time we go through a tiered testing, we pull that up and it's tested very early in the process. The tiered approach, in a minute, I'll show you a flow chart of our workflow, and you'll see tiers of testing, which helps us with confidence level, and it also reduces the possibility of anomalies when we go into the production environment. We are doing extensive testing for this system with the objective of not having issues when we go live and trying to minimize to the extent possible. It's, certainly any transition, we're going to have customer, questions, issues, but we're just trying to reduce them. Okay, and with testing, we have clearly defined entry and exit points, and go live readiness assessed at tier 2. This flow chart that you're looking at this is our workflow, and this is one of the slides we plan on presenting to you every single month. And what you'll see is, what's our progression of work? If there's changes, we will certainly update it, and to tell you where are we today in it. And then where are we today, we'll drill down deeper into that. What you can see is we have software builds, we're in the middle of them now, and then we have scheduled builds as placeholders after critical testing, just in case items surface. The yellow boxes are our 3 tiers of primarily software testing, and they're gated. They're all going to occur on migrated data, and there's code freezes for each of them, and they're occurring in the production environment. So we've got adjustments from before. Tier 1 is performed by TransCore, but the results are presented to our MDTA consultants. So this way we have visibility with the outcome of their testing. Nothing's behind the curtain that we can't see how their testing is occurring and what the results are. If we have, after that, we have performance testing, making sure that the system is loaded, that we can handle volumes that we need to in a production environment. And then we have an assumed software build should anything come out of the performance testing or the tier 1 testing. But for performance testing, for example, right now TransCore is performing performance testing. They've gotten onto a weekly cycle, and we can see the continual increases in the performance of the system responding. The KPI is a 2-second response. We then move into tier 2 testing, which is actually witnessed by our consultants. They see the test being performed, they watch it, they see the results, and they conclude with TransCore as to whether or not something passed or not. It's important, like each one of these tests, there's 1,200 scripts that we run through in each one of these, and each script tests multiple functionality. From tier 2, we go into tier 3. It is the same testing, is performed a second time, but it's witnessed by our consultants as well as MDTA operations staff and finance. We have one additional build, same thing, just in case something pops out. Then we do system integration testing, disaster recovery, and then we start cutover, which spans a 10-day time period. So everything is milestone based, and we can have a go, no-go decision at this level at tier 2. If I move to the next slide, this is where I'm drilling it down into the software builds. And where were we? This was as of the 12th. So in total, we had 650 tickets. When I last reported, we had just under 600. So the rate in which new tickets need to increase or be added is at a slower pace. We have 469 tickets of the 650 have passed. The remaining tickets, 21 of them have been passed by TransCore and need to be validated by our consultants. This is the visibility that I'm talking about. And then we've had 4 tickets fail. TransCore has 119 tickets that they're either deploying, they need to deploy, or they need to test. And then tickets associated with reports, there's 37 tickets remaining for any reports that had issues. And then the pie chart shows you what that looks like. Moving down to the next slide, data migration is also just a critical element. Software development has been of greater concern. We have, with data migration, things have been moving along at a good, steady pace. Not a lot of anxiety regarding data migration, but data migration is still a risk area. We have direct connection with Conduit, and tested and utilized this direct connection for the last 2 data migrations. It takes 14 hours to complete the data migration. So by utilizing and establishing this direct connection now, when we do cutover, we're not using this connection for the first time at that point in time. We would have well exercised it by then. We're doing incremental refreshes every 2 months. And by doing the incrementals, we're trying to reduce the amount of time it takes for the final migration during cutover. We've been doing side-by-side comparisons with Vector. Vector is our current system under Conduit for the past 6 months, comparing data. And all credit card data migration has been migrated to our gateway provider. It's completed and tested, and tokenization have been established. So tokenization is a huge step forward for us. It allows us not to have any credit card information in our system, and therefore reduces our PCI footprint. And then on the table is just a status of tickets that we have. And you can see we have 27 tickets that are open. I'm going off my recollection. I think yesterday this was 12, but please don't hold me to that. But my point is it's steadily decreasing. And our focus areas is the majority of the current tasks. It's about software development. It's about system performance and testing. That's where our focus is. Fixed builds. We have 187 tickets to be resolved prior to Tier 1 testing. That's what I just reported on. And Tier 1 testing is estimated to take roughly a month to complete. System performance, that testing is scheduled in December, as it's early in the process. Previously, it was later in the process. It's been pulled up early, and that reduces risk. And then testing, the 1,200 scripts. It takes a significant amount of time to work through that many scripts. And so we do have a risk of it taking longer. We have worked through these scripts several times in the past. We've identified areas, improvements, things that we can do to streamline the process and the time that it takes to go through these scripts. And we will do that as we go through each one of these tiers testing. So that completes the update from where we were a month ago and where we are now and what we're focusing on in the coming month. Can I answer any questions?
No questions for me. Any questions from members of the board?
Deb, I have Mr. Chairman, I have a question or just a comment.
Absolutely.
Of course, this is a very time-sensitive matter, this implementation, I guess on that, having said that, the timelines, establishing timelines, a schedule, and accountability along the way for all participants, is that not advisable? I've been involved in similar, one on a national basis with a major van line, a rollout of a new system, but in others that I've been involved with, there was always a timeline established for accountability reasons and benchmarking and to also see what kind of impact we would have if we were unable to reach those specific targets. And for example, and you don't have to answer this, but if it's not appropriate, but are the other participants, I know we have consultants, we have others involved, is there any incentive for some of the participants to get this done sooner rather than later?
So not on the consultant, on the consultant side, this contract, it did not have incentives to complete early because we were very aggressive on our timeline to begin with. There are liquidated damages for not completing on time. There is a cap for that for the liquidated damages. The cap is $500,000. So it's, the push to complete, and we are working on a schedule, and the whole push has been, it's got to be a reliable schedule. And that's why we are working on a test plan amendment. There was another meeting this morning to finalize that, and then that will flow into the schedule. So we've been reserved with a schedule, any kind of dates or anything until we have the test plan amendment finalized and everyone has agreement on what the testing looks like. That testing is part of it's the critical path. It's the software development and the testing is our critical path. So there aren't incentives to complete early, and we recognize the impacts that we're having on the agency as we have not transitioned. We're also trying to balance that with having a quality system for our customers to use and minimizing, to the extent possible, any issues that they would experience. So not directly incentives, there aren't incentives to finish quicker.
Thank you. Thank you, Mr. Chairman, too.
Great, thanks, Deb. Any further questions from members of the board?
This is Member Ardinger. I did have a question for Deb.
Sure,
Deb, thank you for this information. And this is more for my own clarification. I'm looking at the workflow test plan, and you show that today we're at the software build. And then if I understand correctly, the performance test, you're looking at did I understand that we're looking at getting to that point in a month is the hope?
Yeah. So yes. So this is the formal performance test. They are performing performance tests. They have begun doing it on a weekly basis, and so they're continuing to make adjustments. They had a Microsoft master in over the Halloween weekend to analyze the systems to be able to improve its performance as high as possible, adding hardware, database structure. They're making adjustments as they continue to run the system and tune it and refine it. So that will continue right up to this formal testing that we will do.
So in other words, we're already basically doing the performance test, just not the official version yet. Is that correct?
And yes, and there's 4 areas that we test. Two of the areas at a load level. It's not the final load level. 2 of them, it was 700. It is very close to 100%. The other 2 areas are in the high 90s. This past couple days ago, when they redid the load testing, it was increased, not quite double the load. And so we'll continue to increase the load to a degradation point and the ultimate failure point, so that we have the understanding as to how much load the system can take. And so that work will continue right on up to this formal performance testing.
And I'm sorry, just one more thing for clarification. So then what I see is at the beginning of the software build, but we're actually working on some of these other levels now. So yes, hopefully we'll move rapidly through those when the time comes, because we're already doing part of the work.
Right. So when we get to the performance testing, when that's kicked off, the expectation is the system will perform well and it will pass the test. And to show a flow chart of sort of everything. This is rolled up at a higher level. The same thing with like the builds. Our subject matter experts, the testing that TransCore is doing, and then our verification, that's also happening now with the goal of trying to give ourselves the best opportunity in the reducing the risk, so that tier 1 testing can go well. And that's the same thing that we're doing with performance testing. This work that's occurring now, we're trying to reduce risk and make adjustments with the anticipation that the performance testing will go well when we get to the formal test.
Thank you.
Great, thank you. Any further questions?
Mr. Chairman, I've got a few.
Go ahead, Mario.
I guess I hate to sound negative on all this because I'm candidly a little concerned that we're late in rolling this out for many reasons. One being we've got overlap with conduit, and we're paying for conduit, we're paying for caps, we're paying for TransCore. That's a lot of money. And even that, I'm guessing that $500,000 liquidated damage cap's not gonna cover that. So I guess I'll ask that question first. Who's paying for this overlap?
So when it comes to processing transactions, only one vendor is paying for a transaction. So when TransCore, they're not being paid to process any transactions. There hasn't been invoices, but invoices would be focused on development costs. So and then with regard to caps and conduit, caps, we're paying them for the lanes, but we're not paying conduit for their lanes. We're paying conduit for their back office. So to the extent possible, we're trying not to pay for anything twice. But there is a however. It is very, like I talked about the black box earlier and moving transactions from caps over to conduit, that is very labor intensive. And so that is higher costs that we would have otherwise avoided and have not avoided. So we're not paying for that same transaction for 2 people to process, but there's other costs that we will incur because of the delay. The black box is the largest example of that.
We're what is your best guess on when you think we're gonna go to the green box on your flow chart? Go live. It doesn't sound like February.
Spring.
It happened. Spring. So that means we're gonna have, and I know we're not trying not to pay for things twice, but it's still costing us money, is my guess. Or can somebody put a magnitude on what those costs are to us?
That is an action item that we have for the board. The member Carol had asked for consultant costs. I received additional, consultant costs above what we originally had forecasted. I received that information yesterday. I just honestly didn't have a chance to look at it yet. So coming back to the board and talking about costs is an action item that we have, and we'll be prepared to do so. We just aren't prepared at this meeting.
So spring is what I think I heard you say. Spring go live. Is that early or late spring? Are we talking? Spring's a range.
Spring is 3 months. Yes.
Yeah. So I'm gonna bet you.
I think at this point we should stay with spring. It's the test plan amendment. And so we're hopeful that is approved and finalized. There was a meeting this morning regarding that. That will flow right into the schedule, which we're expecting to be able to finalize. At that point is when we will have a date, and the risk to the date is it's at the end of the day, it comes down to performance, right? That we're seeing good performance from the perspective of the when we are talking about the builds and the pass rate. We're not seeing a lot of failures. There is taking time to get through these builds, and they have far more builds than what they originally anticipated. But they're to a point where we're having passes. We still have to work through, the open tickets. There's 181 open tickets. So that's where our schedule risk is going to really come into. Is if any one of these tests go poorly, that will affect the schedule. And so the schedule that we have, will make the assumption that the tests go well, but that'll be our risk.
Do they, I'm sure you have expressed to them, I hope you have, that, I don't think I'm speaking out of turn, but I think the board's pretty disappointed that we're as late as we are. And I think we're over a year late, because I think there was an original date that got extended, and then now we're even a year past that. So I hope they're feeling some heat, because I don't feel like, I feel like we're feeling more heat than they're feeling.
I think last meeting, Jim spoke about the pressure. So I believe everyone is feeling, the heat. We're in the middle. I don't know. It's at times, and it's felt by all.
I'll leave it at that. Thank you, Deb. Appreciate it.
Any other questions from members of the board? Great, thanks so much, Deb. At this point, we'll move over to Member Gaines to give an update on the Human Resources Committee.
Okay. Human Resources Committee met last Thursday, the 12th, and Ron Westerfelt gave us a workforce and development programs update. We heard about the use of Cornerstone Learning Management System to provide e-learning opportunities for employees during the pandemic. He provided a summary of the supervisory participation in a biannual supervisor essentials training, which of course was held virtually. He provided a status of our career development program, to include the number of participants and the degrees they sought, and their involvement with, I think, a half a dozen colleges around the metro area. We also heard, we had a toll collector update where we learned about the ongoing efforts to provide toll collection staff with opportunities for employment, and they were able to get a few of them placed through internal competitive reclassifications, whereby they could get in despite the hiring freeze if they changed classifications, and so that's able to get a few of them hired. We continue to work hard on providing a home for all the toll collectors who have lost their positions. We also had an update on recruitment and examinations. We have a newly developed virtual interview guidelines. We heard hiring managers have a new template for interviewing questions, and we were also updated on the changes to the way we proceed with salary negotiations due to the passage of House Bill 123, which is the legislature sort of dictating the way salary negotiations are between not just government agencies, but the private system too. Like, you'll be unable to get salary history of people you're interviewing under many circumstances. I guess so. Anyhow, it just complicates the way we do business. And so, just in summary, the HR department continues to provide learning opportunities for staff while adapting to the pandemic. And they're working on policies that provide structure for employees to deal with the current environment, which is largely teleworking for many of them. But I'd like to give a pat on the back to the HR team led by Percy, Tanya, who tirelessly work at providing innovative and creative strategies, always trying to help employees become better employees for MDTA, but also improving their career paths and providing future managers. That was all I had. Any questions from anybody?
Great. Thank you, Member Gaines. Certainly, these HR topics during this pandemic are pretty critical. And I know we're doing a lot of work across this department to keep our employees engaged, but also make sure they have the right support that they need. But any questions, members of the board? Great. Thanks so much. At this point, we'll move on to what looks to be a bearded executive director, Jim Ports. I don't know that I've ever seen a non-clean shaven Jim Ports.
Yeah, you haven't, Greg. And quite frankly, I wasn't as blessed as you are because it's a mess. But the reason I was doing it is because, No Shave November. And my message was going to be to the MDTA team, especially the guys, because, guys don't like to go to doctors to get their colonoscopies and stuff like that. As a cancer survivor myself, I take this very seriously. But it wasn't just for the guys. I was also going to say it for the gals. So unfortunately, I was unable to tape that episode due to the fact that I got a sore throat and couldn't answer COVID questions. So ugly for no reason. So anyway, with that, as we mentioned, in October, we resumed the NOTD mailings to the customers of video tolling at the cash rate since March, as you know. We're trying to address that backlog, as many have said already today. Since converting to all electronic tolling, our toll collector personnel have been serving as COVID-19 building screeners at MDTA facilities, but we're reassigning them to this project and training them as image reviewers and certifiers. As of this Tuesday, I'm happy to report that 84 of our employees have completed that training, and we'll soon be utilizing an app for building access, similar to what SHA is using. We're not compromising the health of our employees by using this app. Actually, they will be certifying that they are COVID-free from the questions that we would normally ask. We're on our way. We have equipment and personnel to get started on addressing the NOTD backlog. As you know, it's been a full court press from all of our folks. Big shout out to Will Pines, who's leading our effort, and our IT group and our HR group, and also our communications folks. Everybody, again, it's been a all hands on deck initiative, and I think we're making great headway. I also want to share, because I know many of you have asked about the Canton Railroad information, that as part of the Volkswagen settlement with the U.S. government resolving allegations of the Volkswagen violating the Clean Air Act, we were able to secure 2 locomotives. So currently the Canton Railroad has 6 locomotives with Tier 4+ units, each costing $2 million. Canton's contribution was about $100,000 per locomotive. So we're excited that they will be getting new equipment to move forward on their initiatives. I also want to give a shout out to the police. We've heard a lot of criticism, if you will, about the handling of the suicide attempts And quite frankly, it's not recognized on the other side of what a great job our police do in handling these attempts. But Senator Ed Riley commended our workforce at the Bay Bridge. He specifically complimented us on the 2 police recent events at the Bay Bridge. And so again, I just want to give a special shout out to our folks, our police folks and our first responders on those initiatives. And he did give us a Senate resolution due to the length of this meeting. I'm not going to read the whole resolution. And lastly, I'm going to give some bad news, good news. And the bad news is for us, the MDTA team. The good news is for this employee, and that's John O'Neill. John O'Neill came to me the other day and told me he would be resigning from the MDTA. He will be joining Gannett Fleming, the consulting firm. As you know, John has been a tremendous asset to this organization over the last 15 years. And I have to tell you, quite frankly, personally, a tremendous asset to me. John's been a great operations guy. You know, my background's in operations. And so John and I were able to talk the same language on many occasions, pretty much all occasions. And I just want to, I guess, congratulate John O'Neill, as much as it hurts, on his new venture. And of course, we wish him the best. And I hope all of you reach out and thank him for his great 15 years of service. I don't know if he's on the line. I think he might be. If he wants to say something, that's fine with me too.
So, thank you, Jim. This is John, everybody. John O'Neill, hello. I just wanted to thank everyone and thank the board and everyone else for making the MDTA the great place that it is. The employees, the people, the board members, Greg, Jim. It's been a wonderful place to be, learned quite a bit, and made quite a few lasting friendships. And I hope to stay in contact with many of you after I depart year end. But I'm not gone yet. We still have a few things we need to get done. Try to get some things taken care of this fall and winter before I do depart. But I wanted to thank all of you and thank the wonderful staff at MDTA that has supported me over these many years and allowed me to progress and have all these great, wonderful experiences here at the authority. I couldn't have imagined having all of this, all these experiences anyplace else, and with a better group of people. So just wanted to say thank you, and thank you, Jim. Thank you, Greg.
Great. Thanks so much, John. Let me echo Jim's thoughts and just say thank you for your incredible service, not only to the MDTA, but for the entire department and for the state. You know, you've done a tremendous job and certainly made a difference. And I know not only made a difference in the work that we do, but also the teams that you led. So I thank you. John and I have known each other longer than many realize, all the way back many, many years before we were both in the department. So I hate to see him go, but I'm sure he will do great things in his next role. But with that, I'll see if there's any other comments from members of the board. Great, thanks so much. One thing I want to do before I ask for a motion to adjourn the meeting, it was quite a full meeting today. You know, we had a lot of really, really important topics, but some of you may know that, you know, I have a lot of roles as secretary. One of those, I'm very active in the American Association of State Highway Transportation Officials, and I have been for many, many years. I serve on their board of directors, and we had our meetings, our annual meetings last week. And so, you know, the meetings were supposed to be in Baltimore this year for the first time, and they got canceled, of course, from the pandemic. But, you know, one of the things that happened last week during that meeting was that MDTA was given an award that I'll share with the board here for our 895 over Patapsco Flats superstructure replacement project. It was a national award for 2020 for the best use of technology and innovation for a medium-sized project. It was given through the course of America's Transportation Awards. So, you know, it's great news and a great testament to not only the MDTA, but the individuals that really lead those projects. And I know I was on that the other day, and so it really, really is tremendous. And I thank Will and the whole team for their incredible work on that pretty tough project. So with that, do I have any other further discussion or a motion to adjourn the meeting?
Mr. Chairman, I just want to comment.
Absolutely.
Let me just comment on what Jim said about the Canton Railroad. I'll tell you, through the Volvo settlement and through Department of the Environment, it worked through. I'll tell you, the locomotive is a piece of work. It's a rehab, but it's anytime, you know, somebody wants to tour, we'd be more than happy to arrange it. It's really neat. Thank you.
That's great.
You be driving? You be the engineer? Get a ride?
Lee, I'll let you handle that. Remember Gaines?
Okay.
Oh no, I remember Von Paris. He's used to driving those big 20-wheelers, so we can let him do it.
Oh, well, you're funny. You look better in the hat.
Oh yeah, now I can't get that visual of the little conductor hat out of my brain. But do I have?
I have a motion on the floor that we adjourn.
I want to. I'll second it, but for discussion, everybody have a wonderful Thanksgiving holiday.
Happy Thanksgiving.
Great.
Yeah.
Happy
Thanks to all of you.
Thanksgiving, everybody.
Thanks
Thanks
to
to all of
everybody.
you.
Enjoy.
Nice to see you back, member Enzer.
Yes.
All those in favor?
Aye.
Aye.
Any opposed?
Thank you.
Great. Motion carries. We're adjourned. Have a great holiday.
Happy
Thank you.
Thanksgiving, everybody.
Bye, everybody.
Bye.
Bye.